The inflation story is still benign. It's cooling very slowly, but it's still cooling.
We basically now live in a 2% inflation world rather than a 3% inflation world.
You're still running at 3.25%. That's still well above where the FOMC wants to see it.
Consensus is that we are on a downward inflation trend. The Fed does not seem worried about inflation being a little sticky above target.
For the moment, U.S. exceptionalism is a story that's really, really hard to push back on.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back. Those dark days of stock losses, all two of them, ended yesterday with a new record high for the Magnificent Seven. The focus has shifted toward unabashed enthusiasm for central bank rate cuts, and we're getting some big ones. The Bank of Canada and Swiss National Bank both cutting by 0.5 percentage point over the past 24 hours. Now it's on to the ECB, a rate decision later this morning. Futures just losing a little bit of steam in early trading as yields edge upward across the board. In the red, NASDAQ leading on the downside, 0.2%. Not really much to write home about after yesterday's record highs. In the yield space, you are seeing yields climb across the board, particularly on the long end in the U.S. at a time when now the focus goes to if the Fed cuts rates next week, if central banks cut, are we allowing inflation to pick back up? Right now, Jonathan Ferro is off this week. Danny Berger is joining Anne-Marie and myself around the table. Danny, I am curious what you make about some of the front-loaded rate cuts that we're seeing from the likes of the Swiss National Bank and the Bank of Canada.
I'm just wondering how much of this is a willingness to decouple from America, a willingness to decouple at a time where they're facing the threat of tariffs. They already have weak economies, especially in Europe, dealing with political discord. Do they need to get out in front of it and be in a place where they can meaningfully weaken their currency to help some of the growth? And then how much does that come back around to invoke the ire of Donald Trump in 2025?
Well, and this really went to the Swiss National Bank in particular. They actually were pretty explicit in the fact that they want to bring their currency lower, weaker versus some comparative currencies. They even raised the issue of more directly intervening with their currency should this not work. How much is this trying to get all the tools they can ahead of a Trump presidency?
Well, it's also bad news for the Swiss franc because of the politics in Europe itself. It's been a haven. It's had these immense flows because of that. And so they're trying to say, OK, we need to pump the brakes. We need to back off of the strength in the franc before we even have what's coming down the pike from the U.S.
And Anne-Marie, this isn't just a central bank phenomenon. And this is what I find fascinating. It feels as if governments and companies are all reconfiguring, saying we have seen this movie before and we are going to get ahead of whatever might come.
That's right. The writing's on the wall. They have a playbook. And obviously, some of them are probably pretty jealous of Elon Musk and his ability to have this relationship, President-elect Trump, and that bet Musk made before the election. So what do you see overnight? Meta donating $1 million to Trump's inaugural committee. Now, while $1 million isn't really a lot for Meta, right? This is pennies in terms of that company. The fact of the matter is they didn't donate to President Biden's inaugural committee, nor did they donate to Trump 1.0 inaugural committee. So this is tech companies. This is leaders. How many foreign leaders have either called or Trump has sat down with this week alone? Viktor Orban last week, Emmanuel Macron, Volodymyr Zelensky. They want to make sure that they are in his orbit for that transactional deal making.
What's fascinating to me is how different this is than 2016. There was an outright rejection of Donald Trump and what he brought to the White House back then. This time around, it is completely different. There is a feeling that maybe we have seen this movie before, we can work with it. How does that sort of set the trajectory on a different course?
I think for some executives, it's exciting. We heard recently from Jeff Bezos, who's talking about he's very optimistic about what this could mean. And then recently in the NBC interview, Donald Trump said, everyone's calling me, and oh yeah, Jeff Bezos, we're set to have dinner.
Meanwhile, we're going to hash through that today at a time where the focus very much is on the ECB coming out at 8:15 a.m. Eastern, as well as PPI and initial jobless claims just 15 minutes after that, followed by the press conference with Christine Lagarde. Coming up this hour, Brian Levitt of Invesco as the NASDAQ 100 notches a fresh record high. Frank Aquilla of Sullivan and Cromwell on M&A under a second Trump administration, and Soeren of 0.72 ahead of the ECB rate decision. We begin this hour with S&P 500 snapping a two-day losing streak and then now fading just a little bit. Traders boosting bets on a Fed rate cut next week after an inline CPI print. Brian Levitt of Invesco writing, the backdrop for risk assets remains sound given resilient growth and Fed easing. There is little to suggest that this is a business cycle that will be ending. Brian joins us now, and we were just talking about all the reasons why there seems to be at least a renewed bout of outward enthusiasm. Does it worry you that everyone is lining up on the idea that we can get strength without commensurate inflation?
I'm not overly concerned about inflation. I don't think we're going to see a reacceleration in inflation. Instead, what I'm a little bit concerned about is this idea that the U.S. could potentially move to a new, higher, sustained level of growth. I mean, people will focus on tax cuts and deregulation, but not necessarily think about what the uncertainty around trade wars could mean, or what even fiscal consolidation could mean. So it doesn't suggest to me that, again, this isn't a cycle that's ending, but it really comes down to how do you want to think about these markets? Because if you think you're going to a new, higher, sustained level of growth, that's probably a very different investment backdrop than if we're just going to continue in what has been a resilient growth path, but not necessarily one that's reaccelerating to ever new heights.
I saw Steve Asciutto of Mizuho come out yesterday basically saying, sell bonds, buy stocks. And that seems to be what everyone has been saying in an environment, as you said, that is pro-growth. At what point, though, if you have rate cuts around the world that are disproportionate to what we see in the United States, does it make it more attractive? Because traditionally, you chase those rate cuts, and that is your friend, whether it's in bonds or whether it's in stocks.
That's a little bit of the irony of this, because if you remember in 2017, everybody was aligned on a U.S. first story, and non-U.S. markets did very well. So I think people aren't even thinking about the fact that markets outside the United States can perform well, because the expectation is this persistently strong dollar. So the U.S. should do fine. I mean, the median stock in the U.S. is not overly expensive. Yes, the S&P 500 is elevated. The median stock isn't. But other parts of the world outside the United States are priced very modestly. And you just kind of need things to be a little bit better than what they currently are. And you're already seeing some improvements in Chinese economic leading indicators, European economic leading indicators a bit. So maybe that's a surprise to investors next year, is that you start to unlock some of that value.
How low is that bar to say, okay, I can actually buy something outside the U.S.? Because what you're describing, it seems that the bar is kind of low to get some flows into Europe, into China.
The bar is very low. I mean, right, everybody's on this America first. Look, I'm not running away from U.S. stocks, right? But the idea is, do you get a broader market in the coming year, which I think would perhaps surprise people, broader meaning, beyond just the United States. Bar is very low. And you think about the United States in 2023, people were very worried about elevated inflation. People were very worried about all the tightening that had happened. And there was a lot of people bearish coming into that year. And you and I discussed FOMO, right? We didn't want to miss out on it. And I mean, the reality of it was things just had to get a little bit better. You needed inflation to come down modestly. So maybe that is a surprise to investors. Things are going to get a little bit better outside the United States. And you think about, the dollar being so strong, the market's already priced that the Fed maybe won't cut as much, the tariffs. So a lot of that's already baked into this.
There was an assumption, though, that even just within the U.S., there'd be a broadening. You saw a little bit of that after the election. But this most recent leg higher to new highs has been about the same players, has been about tech, has been about the Mag 7, has been about Tesla. How much of this is a preview of sort of maybe a false dawn of the small cap, mid cap broadening for 2025?
Yeah, that's a bit like if you think back to 2016, 2017, very early on, interest rates jumped. Cyclicals outperformed defensives, right? The whole Trump trade, which didn't persist in 2018 because of the uncertainty around the trade war, because of Fed tightening. Now, this time's a little bit different because you're not going to get the Fed tightening, but you may still have the uncertainty around the trade war. I would expect markets to broaden out largely because the earnings differentials are likely to moderate. Now, that's nothing bad about the Mag 7 over the next 5-10 years. Rather, as everyone's talked about, pretty significant investments that they've made. And so the earnings growth moderates. Small cap, mid cap seem to be closing that gap a bit.
During the first Trump administration, when potentially information was leaked to the press about pulling out of, say, NAFTA and stocks sold off, Trump quickly reversed course because he cared about where the stock market is. Today, he's going to be ringing actually the opening bell at the stock market. Do you think we get that similar tone from the president?
I do, but you have to remember that, sometimes these things can get away from you for a bit. And so we haven't had any market volatility in a very long time. It's been a very benign period. And typically market volatility arises when you have policy uncertainty. We saw.
What is that catalyst, though? What would be that uncertainty?
So I keep coming back to the fourth quarter of 2018. I think a lot of people don't remember it. It wasn't an ideal Christmas. The market was down peak to trough 20% by Christmas Eve from 3 months prior, and that was the uncertainty around the trade war. So, yes, the administration stepped in, provide better clarity on where that was going. The Federal Reserve backed off. So it was a sign that the administration cared. Right? So my sense is that you may get a pullback in 2025 that people aren't expecting, a policy-driven pullback. That's not the end of the cycle, right? That would be a correction that we haven't had in a while.
But when you say policy-driven, that catalyst you think would be something like tariffs. It would be because of the trade war.
Yeah, as long as if there's not clarity on it, right? If you say today this is where we're going and that's where we're stopping, businesses will adjust. The challenge we had in 2018 was it was a full year of trade conflict, and anytime we went back to our computers, we would see a new tweet about something. And, obviously that's how the incoming president likes to conduct business, keep your trading partners on their heels. But the challenge of it was business investment slowed significantly. It actually stalled. And the market started to look at, if we keep going down a tighter monetary policy path and ongoing uncertainty around the trade war, we may have a recession. And that's what the fourth quarter of 2018 felt like. And of course, again, the administration adjusted path because they do care where the S&P 500 comes. I guess this is the Trump put now, not just the Fed put. So that's the risk. I would advise investors, if that were to happen, that's a buying opportunity. Great, because this doesn't feel, end of cycles don't feel like what we're looking at right now. So
this doesn't sound like you're a raging bear.
No.
But you don't feel like as much of a FOMO kind of guy as he used to be.
Well, we just had back-to-back years of 25, 30% in the market.
Well, hold on a second.
To
build on that, are you taking advantage of some of these other areas, like outside of the United States?
Yeah, it's worthwhile looking into these other parts. I mean, for one, you're very concentrated in the broad U.S. market. So if you want to equal weight a portfolio or add some size, add some value, add some non-U.S., you still want to be exposed to the U.S. market. But yes, take advantage of other opportunities over the next 1 to 3 year period.
Including China?
Including China.
Brian Levitt of Invesco, thank you so much. And we mentioned China as they come out with more insight into potentially what we're going to get, whether it's issuing debt, whether it's potentially even vouchers for individual consumers. You can see consumer stocks over in China this morning coming out. Anne-Marie, the latest now is also more trying to get ahead of Donald Trump becoming president.
Right, and they're talking about continuing efforts to stabilize the property market, which has been a huge drag on the domestic population. Earlier, before we got these headlines, we also heard from China's Commerce Ministry saying they're willing to strengthen dialogue and coordination with the U.S. to manage differences. They are trying to get ahead of Trump 2.0. One thing we have yet to hear, though, is whether or not Xi Jinping has any plans to make his way to the United States.
And this is going to be key. We'll talk about that more, whether he'll also donate $1 million to the inauguration plans. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahaira Hackes. Yahaira.
Hi, Lisa. French President Emmanuel Macron is expected to name a new prime minister today. The replacement for Michel Barnier will look to form a new government and restart formal budget talks. Macron faces a deeply divided National Assembly, which ousted Barnier last week by parties on the far left and far right. Parties across the political spectrum have agreed to vote in favor of a special law to avoid a government shutdown. And staying on China, CBS is reporting that President-elect Donald Trump invited Chinese President Xi Jinping to attend his inauguration next month. Xi's attendance, however, would be unprecedented for several reasons. No Chinese leader has ever joined an inauguration ceremony of the U.S. president. In fact, no foreign head of state has attended one in more than a century. That's according to State Department records going back to 1874. And shares of Adobe are falling more than 10% in the pre-market, the software company offering a full-year forecast that fell short of analyst estimates, adding fuel to concerns about the company's ability to compete against emerging AI startups that are making headway in the space. Adobe has been adding Gen AI features to its applications like Photoshop and plans to offer a new, higher-priced AI model to its Firefly. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Up next, gearing up for an uptick in mergers and acquisitions.
I think we're on the on the verge of a really big uptick in M&A. We've seen a change in administration, which will create a more favorable regulatory review and competition approach.
That was one of the most bullish interviews I have ever heard. We'll be talking about that coming up next. This is Bloomberg. Markets a little bit softer. The S&P lower by about 0.1%, almost 0.2% after yesterday's record high on the Magnificent Seven. What you can see, yields higher, and this is what I'm focused on. Yesterday, fascinating to see that even after bang-in-line CPI print, after basically an auction that went well, then people started to get nervous about maybe what this meant for long-term inflation. Meanwhile, under surveillance this morning, gearing up for an uptick in M&A.
I think we're on the verge of a really big uptick in M&A. We've seen a change in administration, which will create a more favorable regulatory review and competition approach. So we look at 2025, and we just can't wait for it to get going. My prediction is, other than 2021, which was an aberrational year, this could easily be the best M&A year we've had in say, 10 years.
Here's the latest. President-elect Donald Trump naming Andrew Ferguson as incoming FTC chair to replace Lena Khan. The move raising expectations for mergers and acquisitions under Trump's second administration. The news coming just as grocery store chain Albertsons backed out of a merger agreement with Kroger after it was blocked by a federal judge, as well as following up with a number of vicious back and forths in the legal space. Frank Aquilla of Sullivan and Cromwell joins us now, who focuses on mergers and acquisitions. Frank, we heard that incredible bullishness from Paul Taubman. How much is that what you're hearing from pretty much every single one of your clients right now?
Well, I think, first of all, we are definitely hearing it from the investment banking community. And, Paul has somebody I've worked with for a long time, and he certainly knows, what's happening in the markets. What we're hearing from clients is that, deals they talked about 18 months ago, a year ago, they are now talking about, okay, now's the time to do it. Because one of the concerns under the current administration is that even if you got approved, because 98% of the deals go through, is it was taking 6, 9, 12 months for deals that had no anti-competitive aspects to it. So there was a real concern that you'd get tied up in the process and it would sort of freeze you from a strategic financial point of view. So the view is that things are going to happen much more quickly. Yes, certain deals will get blocked. Certain deals will get challenged, but it's going to be a distinct minority.
Is there a clear sight of what will get blocked? That there is a certain type of transaction that will come into focus, whether it's foreign money coming into, say, a steel company, or whether it's, say, a tech company looking to pick up another smaller firm?
Well, I think we have to remember that, even in the Ronald Reagan era, which was pretty wide open in terms of merger clearance and antitrust generally, there were deals blocked. So anti-competitive deals have been blocked in every single administration, and I'm sure will get blocked now. Which sectors will they look at more closely? Certainly tech, healthcare to a certain extent, retail, things of that directly impact the consumer. Those things are definitely going to get looked at very closely.
What do you see the appetite in for foreign companies? And is it driven by this carrot and stick idea of potential tariffs, or is it because they want exposure to U.S. exceptionalism?
I think we were going to see a lot of inbound M&A from Europe and Asia, particularly Japan, even if Harris was elected. The drive is that the U.S. is growing. The markets in both Europe and Asia are fairly stagnant. So that's first of all. The second thing is, if you're selling in the United States, you want to be producing here because the cost and the potential disruption in the supply chain becomes more difficult. So we would have seen it anyway, but it's going to be increased now.
So what would have been your advice for Nippon Steel? Wants to overtake U.S. Steel, manufacturing factories continue to be in the United States, but both Biden and Trump said that they would block this deal.
I think that's pure politics. Pennsylvania was, the big state in play, and that's really...
So maybe just timing. Don't do it around a huge presidential election with the #1 swing state in focus.
Hopefully that still happens, but we'll see. Mm-hmm.
I just wonder for companies that are, or private equity or looking abroad, and companies that have international supply chains right now, and they're faced with a potential reality of tariffs changing the entire cost of business. Is that putting deals on ice right now? Are things getting a second look because of the risks in 2025?
I think people have been focused on supply chain issues, not necessarily because of tariffs, but since the pandemic. And that's really when we saw the first disruptions, which a lot of it is what led to inflation. So companies are very much focused on that. But I think it's a driver of transactions as opposed to an impediment to transactions.
One of the other hopes for a driver of transactions was just a lower rate environment. And we've got that to some extent. But there's a fear right now in this market that the Fed can only go so far. Maybe it's a cut next week and then a pause.
Right.
What does that do to deal activity?
First of all, interest rates are at historically low levels. I mean, we think about the last couple of years when they were extraordinarily low. But, if you look at the Japanese economy where they've had, close to zero interest rates and very stagnant business activity, I think, if the economy is growing and you can build in a 4% interest rate or whatever, you can make most transactions work from a financial point of view. And also, right now, you have a tremendous amount of cash, whether it's private equity groups, strategic buyers, they have cash on their balance sheets, so they don't need to borrow as much. So I think that's a driver as well.
That said, valuations will basically take a hit as a result of rates being higher now than, say, when companies got founded or were bought out by certain private equity companies. And arguably, this is the reason why we haven't seen more exits, why we haven't seen more activity. How much will there be a reckoning in valuations, even if some of these deals get back on the market?
Well, one question is whether or not companies are going to be valued much longer term. So not looking at sort of the next 12 months, but really, 2, 4, 5 years out. And so to the extent that you're doing an acquisition, I think you're going to be prepared to look at it much longer term. In terms of exits, I know talking to people in the VC and private equity world, they've not had a lot of exits the last few years. They're looking forward to a number of exits next year. And I think they're also, whether it's through sales or IPOs, I think the IPO market's going to be hot as well. That's not my area, but I think it's going to be hot.
Paul Taubman said that it's going to be the fastest M&A market in 10 years. Do you agree?
Yes.
Frank Aquilla, thank you so much for being with us. Frank Aquilla of Sullivan and Cromwell. Really insightful as people keep talking about how much activity there's going to be, whether it's banking or whether it's in the private equity sphere, Danny. It's pretty much what we're hearing across the board.
I find the point about deals happening just faster to be a really fascinating one. Earlier this year, I had a conversation with Orlando Bravo of Thoma Bravo, who does a lot of deals in tech. And he said that the process was so gummed up, that they've had to completely change everything they do, that they could get deals done. But to Frank's point, it was taking a really, really long time. So for someone like him, it will be welcome relief.
And potentially, if you were thinking of doing any M&A this year, why would you do that before a presidential election when you know potentially you're going to get the same kind of regulatory overhang of the Biden administration? Has been very tough on antitrust versus maybe waiting it out and new sheriff in town, as they say.
Are you advising me, Penn Steele? Post facto advisory tip. Maybe not during an election in a swing state. Meanwhile, coming up, Bloomberg's David Gura on his exclusive sit-down with Treasury Secretary Janet Yellen and some of her warnings on tariffs, on trade, going into a different administration. This is Bloomberg Surveillance. fact, taking back a little bit of what they gave yesterday with the NASDAQ 100 losing the most. Yesterday, reaching a record high led by the Magnificent Seven as U.S. exceptionalism once again ascended in big tech. Right now, NASDAQ not so much, down about 1/3%, because the S&P futures down about 0.2%. More interesting to me was actually what happened in the yield space yesterday. We got CPI came out bang in line with expectations, albeit rising the most going back to earlier this year. At the same time, you saw initially a rally in the bond market, and then, Danny, something changed as the session grew older.
Yeah, which, by the way, you had a strong bond auction, too, so you can't use that to describe what happened. Maybe it is this fear that we know the Fed's going to cut, or at least we assume so, because they say they will. But CPI being not too hot, is that really a good justification to be cutting, especially when the Atlanta GDP tracker is printing 3.3%? There's some nerves in this market, Lisa.
Yeah, especially because, yes, it came in line, and everybody said, wow, that's so good. And then you started to get the roundups. You started to get the exact decimal places that were a little bit higher, and people started to say, hold on a second. You saw the biggest increase year over year in a year and a half. And actually, all of a sudden, people are wondering, okay, if the Fed cuts and you've got the ECB cutting and you've got the S&P cutting and the Bank of Canada cutting, what does this mean longer term for inflation? And suddenly, that long end really saw the sell-off.
And then you look at kind of what are the weaker sectors, the rate-sensitive sectors of the economy, things like housing and manufacturing. Sure, they don't look great. They're wobbly, but they're not getting worse. You could even make the same argument for Europe, which you assume they're going to make bigger cuts. That, look, inflation is still a little bit too high. There is some weakness, but it's more just sort of the politics of it all and the fear of what's coming in 2025. The here and the now maybe doesn't justify 50 basis points of cuts.
Maybe. Either way, right now what you are seeing is a very strong focus on the FX market, in part because that is the main transmission mechanism of some of what you're seeing over, particularly in Europe. What you can see is a weaker Swiss franc, and this is by design. This is what's really interesting. You're seeing the euro strengthen just a touch versus the Swiss franc, the euro strengthening just a touch versus the dollar, basically flat. The Swiss franc weakening deliberately after the Swiss National Bank cut rates by 50 basis points, leaving them, Emery, with a 0.5% interest rate, benchmark rate. That is their key rate. And then this morning, a headline dropping that the SNB doesn't like negative rates, but they do work.
But they work. So basically opening the door to the fact that because they have such little dry powder because rates are so low, they are willing to take it negative if need be, especially as they see a more protectionist White House coming into play in 2025.
We'll develop that throughout the morning. Under surveillance this morning, evidence mounting against the alleged suspect in the shooting of health insurance executive Brian Thompson. The NYPD saying Luigi Mangione's fingerprints and the gun he had on him at the time of his arrest match evidence from the crime scene. Police are also investigating wanted posters of senior executives that have been hung in parts of Manhattan. This, to me, is really the big question mark, Anne-Marie. How much can police get ahead of any kind of copycat action that might threaten executives of major companies?
This NYPD bulletin that they put out on Tuesday is scary. It says both prior to and after the suspected perpetrator's identification and arrest, some online users across social media platforms reacted positively to the killing, encouraging future targeting of similar executives. Not just can they get ahead of it, but how much are these executives going to their C-suite and saying, actually, we need to upgrade and boost our personal security?
Well, we know they've been having those conversations. Various security heads have said they've been fielding more calls. Shortly after the shooting, there was a gathering of security experts for companies looking at spending more because there is this fear at the moment. And it all just kind of translates to how strange this case is going to be, how strange this trial is going to be. Even before we get him on the stand, the idea of them picking jurors to find people in the public who aren't swept up in all this discontent, who aren't swept up in concerns about the healthcare industry. There's so much evidence against him. But the trial could still be difficult, just given on that very fact.
That trial will be in New York. Over in Washington, D.C., CBS reporting that President-elect Donald Trump invited Chinese President Xi Jinping to attend his inauguration. Xi's attendance would be unprecedented, with no Chinese leader ever joining an inauguration ceremony for a U.S. president. So, Anne-Marie, what gives here?
Well, no foreign head of state has been to inauguration since 1874. What I would say on the inauguration committee, they constantly reach out to foreigners and have some sort of representative. Usually it's the ambassador that shows up to inauguration. I think part of this is just, Trump using his raw power. He's constantly spoke on the campaign trail. He had a great relationship with people like Xi Jinping, and he could be the guy to get the deal done. So maybe he invited him over to say, well, then come to my inauguration. What Xi Jinping is doing and the CCP is preparing, though, for what Trump 2.0 means in terms of higher walls, tougher tariffs.
I'm just trying to understand what the upside of Xi being in D.C. for the inauguration actually would. To see him in the crowd, bundled up on a cold D.C. day.
It's not happening.
But, I mean, imagine the optics of well, thank you, Anne-Marie, but the optics of Trump saying something and he literally can't respond and he's sitting there in the front row. There's little upside to that.
This reminds me of when you have two girls and one of them has been trash talking the other one and the other one invites them to a party where they're going to show up and no one's going to like them and they know they're not going to come. It's just a massive power movement, but I'm going to put that aside. Meanwhile, NVIDIA ramping up hiring in China. Sources telling Bloomberg the chipmaker will end the year with about 4,000 employees in the country, up from about 3,000 at the start of 2024. That included 200 people added to a team in Beijing working on new autonomous driving technology. Fascinating, Danny, that at a time when we're talking about China cracking down on U.S. companies, you have a major U.S. company, the largest company, expanding in the region.
China specifically cracking down on NVIDIA, too, earlier this week saying that they were probing a takeover they were doing, probing it on antitrust efforts. You feel Jensen Huang in the middle of these two world superpowers, trying to navigate them both. Shortly after Trump was elected, Huang said that he would agree with any sort of restrictions he put on place. He would comply with it. And he was also just in Hong Kong giving an address saying that China is a great place for AI innovation, even though they can't sell their most advanced chips into China. So I think in one way you could very much so view this as a diplomatic overture, saying we're going to be hiring in China, we're committed to this market, even though we can't sell everything we want to into it.
At the same time, you have incoming officials like who is going to be the Secretary of State Marco Rubio, Jameson Greer, who's going to the ambassador at USTR, basically saying we need to decouple. There's no silver bullet when it comes to China and their dumping of excess capacity on foreign markets, and also how they treat U.S. companies, saying we should decouple. So how much harder is it going to be for any company to start ramping up this hiring like we've seen at NVIDIA?
Talking about future Secretary of State's current Secretary of State, Treasury Secretary, or not Treasury Secretary of State, Treasury Secretary Janet Yellen urging the U.S. to maintain open channels with China. In an interview with Bloomberg's David Gura, Yellen also expressing concerns about wider tariffs. Take a listen.
Broad-based tariffs, almost all economists agree that what they will do is hurt us by raising prices, possibly substantially, and making it more expensive for firms that need inputs from China to be able to acquire them, and harm our competitiveness of firms that rely on those imports. A broad-based approach, I have serious concerns with.
Bloomberg's David Gura joins us now. David, what was the main takeaway for you, given the fact that Janet Yellen knows that her time as Treasury Secretary is limited, and she's handing over the reins to administration with a very different view than what she's had?
I went into this interview wondering how she was going to be. Was she going to be wistful? Was she going to be worried? Was she going to be ready to head for the exits here fewer than 40 days? I think that she retained some optimism that in the time that she has left, she's going to be able to convey, yes, to the American people, all that this administration has done in terms of economic policy, but also convey to this incoming administration what's important, what she's learned while she's been on this job. So taking China as an example, she has perhaps the best conduit of communication between Washington and Beijing. She believes that rebuilding that was crucial, that it's important to maintain the integrity of that. I think she wants to convey to Scott Bessent and his team that there should be an effort to preserve that, even if the rhetoric from on top, from President-elect Trump, is going to be in favor of these kind of universal punitive tariffs. You misspoke and called her Secretary of State. You can be forgiven for that because she's had such a huge diplomatic role in the job. I mean, she is somebody who's really embraced the kind of international profile of this job, and I think that that's something that she's also trying to convey, maybe indirectly to Scott Bessent, is that there's more to this job than just focusing on tax policy and some facets of domestic policy. You really are kind of a huge paramount policymaker for the country and a huge person on the world stage, and I think she wants to kind of emphasize that in these final days.
The two did have a call, and I'm wondering how much of that centered on this idea of tariffs. It's interesting to hear her say that there shouldn't be blanket tariffs because she lost that argument within the Biden administration. It was Treasury that wanted to maybe lift some of the Trump tariffs, and they kept them on. Does she have any insight into potentially how that could have been handled differently?
We didn't talk about the history, but it's a very good point. And, I think that what was interesting is how she still, somebody who was trained and worked as an academic economist, really relies on the literature and what we know of the effects of these tariffs. And it's kind of almost funny to hear that in this moment when the rhetoric seems to have shifted so much to the way that the future Trump administration thinks things could be, or how these tariffs might work out, or the effects that they might have. She is still somebody who I think recognizes the kind of usefulness of tailored or finely tailored tariffs, not broader-based ones, but a very good point about how she lost that fight.
So they have like 6 weeks left.
Yes.
Jenny Leonard and I were reporting that potentially they're going to go a lot harsher on Russia right before they leave the administration. Do you get a sense that they're ready, her and her OFAC team are ready to cripple Russian oil revenue even more with sanctions?
Very grateful that you had that story because I could ask her about it when I came in. Can you confirm that these discussions were taking place? And she didn't want to get ahead of sanctions, she said, but she did talk about the opportunity when it comes to oil at this moment in time, given the price of oil. And I think probably a dissatisfaction and frustration with the fact that the Russian economy has proven to be, I think, more resilient than she would have hoped or expected it to be. And that's not to say it's what it was before this incursion began, but certainly this is a thing that they could target, be that crude exports, be that the shadow fleet of tankers. And she did allow, and not directly, that it's something that they're exploring and they see the opportunity for it in large part because of just the economic situation that they're in right now.
I was also so fascinated what she said to you about fiscal sustainability, because there is some irony in it, given that fiscal deficits ballooned under the Biden administration and under Janet Yellen. What did you take of her, I guess we can call it, apology of their lack of more work?
So here there was that wistfulness, I think. And, she's somebody who, over her long career in Washington, has been identified as a fiscal hawk, and that really has not been a facet of her tenure in the Treasury Department. It began with all of this spending because of the pandemic. She brought this up at a Wall Street Journal event earlier this week. We talked about it ourselves, and she leaned on the fact that in the budget that the president proposed, there were efforts made to kind of reduce the deficit. Of course, none of that's come to pass. Not even the budget has come to pass because we don't have regular order in the way that we used to before. But I think that it is something that she does have regrets about. She said that explicitly, and I think that she recognizes there's a failure of progress there. And also, I asked her directly, are you worried about kind of the state of fiscal matters here in this country going forward? And it is something she said that is of concern to her. And I think that there's a recognition of the fact that it doesn't seem like that's likely to change markedly here.
Did you get a sense of how she feels about her legacy, maybe looking forward to not being in that position anymore? But we're about to get a very different Treasury Secretary and a very different Washington, D.C.
She talked a lot about the institutions that she's been a part of, and she really has had this extraordinary career where she's been in the White House, she's been at the Federal Reserve, she's been at the Treasury Department, and had leadership roles in all three of those places. So I think she's reflecting on that, the opportunities she's had and the work that she's done, but things are likely to change. And I think the backdrop to all of this is that the policies that she's kind of pioneered and been party to, so supply-side economics, multilateralism, these are all things that she's really worked hard on, tried to evangelize for. And you're right. We're at a point where all of that's changing. And again, while she wasn't evincing any sort of sadness in that interview, I think it's a real moment where things are starting to change. And she's kind of recognizing that as she goes back to perhaps California, where she spent a lot of time. And I think she's going to divide her time between D.C. and California.
Sounds pretty rough. David
Yeah.
Gura, thank you so much. Wonderful interview. Really excited to really just deep in and dig. And you actually have another interview coming up, which we will get to in a minute. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. China is vowing even more fiscal support. Top officials led by President Xi Jinping are promising rate cuts, a higher budget deficit, and efforts to boost the property market. Comments come from the Central Economic Work Conference in Beijing. China is facing uncertainty heading into 2025 with the threat of new tariffs and a possible trade war under the incoming Trump administration. Meanwhile, the International Energy Agency expects a global oil glut next year, despite OPEC Plus delaying its supply increases. The agency is saying that if the group continues with its plans to revive output in April, world markets will still face an oversupply of 1.4 million barrels a day. And they say that if OPEC Plus were to cancel hikes for all of next year, there would still be a glut of 950,000 barrels a day. And Microsoft will take an $800 million charge after General Motors shuts down its autonomous cruise operation. The tech giant had announced a minority investment in the initiative back in 2021. Microsoft said in a regulatory filing that the charge will have a negative impact of about 9 cents a share. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, the U.S. versus the rest of the world.
People are long U.S. versus rest of the world in the equity space, and it's going to take something to kind of shift that trend. It's hard to convince someone to sell the U.S. and buy European equities right now.
That's next. Maybe someone who actually has a different take. This is Bloomberg Surveillance. Futures pulling back just a touch after yesterday's all-time high on the Nasdaq 100, led by the Magnificent Seven, a 0.2 decline in the S&P. Yields higher, and I'm watching this space at a time where you actually had an okay auction yesterday. 10-year yields in the U.S. 4.2964, rounded up to 4.3%, at a time where yields in Europe falling lower. Under surveillance this morning, the U.S. versus the rest of the world.
People are long U.S. versus rest of the world in the equity space, and it's going to take something to kind of shift that. The positioning and sentiment setup is a little bit offsides, to Lisa's point, on U.S. being sort of exceptional versus rest of the world. It's hard to convince someone to sell the U.S. and buy European equities right now. Both for Europe and China, you could have episodic periods of outperformance, especially given the positioning dynamic. The question is follow through.
Here's the latest. Under 2 hours away from the final ECB rate decision of the year, the central bank widely expected to cut rates for the fourth time this year as it looks to boost the region's struggling economy. Soeren Radde of European Economic Research writes, the Governing Council is likely to put a more emphasis on downside growth risks, with inflation at target earlier than previously anticipated and growth risks skewed more strongly to the downside. We expect dovish rate guidance changes. Soeren Radde of 0.72 joining us now. Soeren, I'd love your take right now on just how low the bar is for the European economy to outperform.
Good morning, Lisa, and thanks for having me on the program. I think the European economy is going to have a difficult year next year. There are a lot of headwinds. Some of them, of course, have to do with the international environment, with the prospect of a potential trade war. Some of them are very much homemade, like political uncertainty in France. And in an environment where I think fiscal policy in Europe at least has very little by way of being ability and capacity to lean against that, it's really hard to see for Europe to outperform those low expectations next year. The ECB is really the only game in town at the moment.
And this is the reason why people are calling for maybe even a 50 basis point rate cut. Pretty broadly, everyone's expecting 25 basis points. They're not going to follow in the footsteps of what we saw from the Swiss National Bank. But maybe this is just a concession to some of the more hawkish members to create a more dovish tone as to future guidance. Is that your take as well?
I would say so. I mean, ECB decisions and communication, they're usually a package, and they're usually some sort of a compromise that makes most people happy. ECB President Lagarde is also a leader who, strives to have a broad consensus in the Governing Council. And that then often means that they, take not radical decisions, but essentially come up with a package. So today, I think that will mean 25 basis point cut paired with guidance changes. And those guidance changes, I think that's really the bone of contention of this meeting.
Soeren, I'm interested by this idea that you say the ECB is the only game in town, because there have been other, so to speak, games presented. That is the Draghi report for steps that Europe can take to promote growth, with little expectations of that happening. Is an ECB that continues to cut rates, that forces the euro weaker, is that enough to get the European economy off the ground?
We don't think it's enough to get the economy off the ground in the near term. That's why our forecast for growth next year is just 0.8%. That's below consensus and about 1/3 of where we see US growth. We think it will take time. I think there are some factors looking into 2026 that can make us more constructive. Hopefully some form of trade deal with the US is one of them. The lagged effects of ECB easing is another one. And we do expect the ECB to actually cut rates further than they now think they will, so into accommodative territory. Another one is a potential truce of whatever form in the Ukraine, with subsequent reconstruction efforts. So there are reasons, I think, to be more constructive about 2026, but I think all those factors will take time to shape out, and so 2025 is, I think, going to be a tough lift.
There still is this irony of an ECB, if they continue to cut, because inflation still isn't at target, Soeren, and it presents this argument of moral hazard, that politicians in Europe are acting recklessly because they know they have an ECB that has their back. Do you put any credence to that? I
mean, I would say, first of all, to your, to inflation, we're now expecting inflation in our own focus at 2.2%. The ECB is probably going to be a bit below that next year, and then essentially staying at target with risk to inflation coming lower, right? So yes, core inflation is still running well above target, but a central bank that is faced with such a weak growth outlook, I think, should be more forward-looking. I think we've heard from several speakers, including Christine Lagarde, that that's the direction of travel. They want to and expect to become more forward-looking. They're just not there yet. I think in practice they are there. So inflation is not really the main concern. As to your question on moral hazard, I think in general, financial markets are a pretty powerful disciplining device. And, yes, we've had a lot of political turmoil in France. And in the end, we expect the deficit in 2025 to be not much smaller than the one we're likely to get this year. In other words, with a 6 handle. But on the other hand, we've seen that financial markets are pretty reactive to political uncertainty and will over time exert pressure. And I think that will have an impact on fiscal policy eventually without the ECB having to administer that kind of discipline.
Well, the former ECB head, Mario Draghi, called what's going on in Europe low productivity, calling it an existential crisis. Do you think this current ECB views it the same?
I think they are concerned. I think they're particularly concerned about, and that's actually, I think, there's broad agreement around that in the Governing Council. They're very concerned about, potential growth in Europe, structural headwinds, high energy prices, loss of competitiveness. Now, trade fragmentation as another headwind, a war on the doorstep of Europe. So the macro environment is just very, very challenging, through an aging as well. So there are lots of transformations that are going on. The disagreement is whether that's something for the ECB to fix, right? So yes, I think they're concerned about it. They disagree whether that's something that monetary policy can fix, since monetary policy, is a tool that can manage fluctuations, the cycle, but not structural shifts in the economy.
Soeren, you used to be an economist on the ECB. You've worked in this industry a long time. I'd love your thoughts on what we heard from the Swiss National Bank's president this morning, where he came out and said that nobody likes negative rates, but they do work. Do you agree? Do they work?
I mean, by and large, yes. I think, in Europe, for example, we've had that experiment. The ECB has obviously experimented with taking rates into negative territory. They work in theory, in economic theory. I think they've worked in practice as well. They've certainly had, big impact, a strong currency channel. I think they also have a signaling channel. It's a step to take rates into negative territory. And, no central bank does that lightheartedly, as the Swiss governor said. And so, if central banks do that, it says something about the path, and through all these channels, I do think it has an impact. And if I had to judge standing today, what is more likely coming in Europe in the future, is it more QE or again negative rates? I think at the moment the pendulum has swung in favor of negative rates as being the instrument that probably comes with less side effects and can be reversed more quickly. And if I think back of my own time at the ECB when I was a staffer and thinking about these at the time unconventional instruments, the received wisdom at the time was probably the other way around. So QE was a little bit more the favor tool, and negative rates was really uncertain. So I think the fortunes have really turned a little bit in terms of the preference for these two instruments.
Soeren Radde, wonderful insights. Thank you so much, Soeren Radde of Point72. We really appreciate you being with us here ahead of that ECB rate decision. Coming up next hour, Peter Tchir of Academy Securities, Ed Mills of Raymond James, Holly O'Neill of Bank of America, and Mike Collins of PGIM Fixed Income, as we are about 1 hour and 15 minutes away from that key ECB rate decision. And in 15 minutes after that, PPI and initial jobless claims. This is Bloomberg Surveillance.
Right now, the market is very happy with the fact that soft landing is still the story.
Sentiment is very positive, but I think sentiment is positive for a reason. The economic growth's been surprising to the upside.
My confidence in the economy next year growing over 2% is still relatively elevated.
It's really about this intersection between quality and value that we think can power markets higher into 2025.
This is a really good economy for financial markets. The question is, can we sustain it in 2025?
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back. 75 minutes until an ECB rate decision as the focus globally shifts to synchronize rate cuts. We already got some from the Bank of Canada, from the Swiss National Bank. We expect a 25 basis point cut from the FOMC next week. And then today, the expectation is for the ECB to come out and deliver at least 25 basis points of a cut with probably some dovish language. Markets pulling back after yesterday hitting a record high on the NASDAQ 100. It seems as though we are shifting toward an environment where people are on the margins, less concerned about near-term inflation and looking more to just how much different central banks around the world, Danny, can cut rates.
And we saw it from the S&P, 50 basis points. The issue is if they already need a cut now because there's economic weakness, what happens in 2025 when they face tariffs, when they face those external pressures, and they don't have the sort of firepower that they need, that the ECB is the only game in town to the point of Soeren read, that you don't have some sort of cohesion among governments in Europe that can handle anything that might come down the pike in 2025. Thus, you get the S&P talking about negative rates because rates are already low and they need more firepower to deal with whatever next year might bring.
And why do they need more firepower? It's because of the currency channels. And what you can see is a Swiss franc that has strengthened dramatically on the weakness that you're seeing in the rest of Europe at a time where otherwise they want their exports to give them some sort of tailwind. This morning you are seeing the efficacy of cutting by 50 basis points. But Anne-Marie, we are going down to 0.5% with their key borrowing cost, which isn't leaving a lot left for potentially some of the tit for tat that we could expect.
And that's why you have the S&P coming out and saying they don't like negative rates, but they are effective, opening the door to potentially maybe in the future, especially if we are dealing with higher tariffs and we have a difficult export environment. Maybe we would have to go there into that negative rate. But it's not just central banks, it's governments. China today coming out saying they're going to have more looser fiscal policy. The Commerce Department in China coming out saying we would like to have a dialogue with the United States. And it's companies, Meta, donating to Donald Trump's inaugural committee, $1 million, not a ton, but it's the symbolism across the board. Companies, central banks, and governments getting on board and getting ahead for what's coming down the pipe next year.
And they are concerned. And again, I just go back to how much that contrasts with the animal spirits. Central banks are fearful they're taking actions. Company executives are trying to call Trump. Meanwhile, stocks are continuing to bump up against all-time highs. Meanwhile, every CEO survey is so optimistic. The small business survey sentiment is really optimistic, too. There does seem to be a sort of disconnect with all those things, and not to mention a bond market, too, which recently has been selling off.
There's been a real question here about how this time is different from 2016, in part because of the learned experiences back then and the fact that the world adapts and adjusts, whether it's central banks or whether it is companies. Coming up this hour, Peter Tchir of Academy Securities, a CPI boosts rate cut bets, at least near term. Ed Mills of Raymond James with a tax cut fight looming on Capitol Hill, and Holly O'Neill of Bank of America on the outlook for consumer banking in 2025. We begin this hour with stocks just slightly lower, led downward by the NASDAQ 100. Still yesterday, those tech stocks hitting a new record high, the S&P 500 snapping a two-day losing streak, boosted by mega cap tech as inline CPI all but ensures more Fed easing. Peter Tchir of Academy Securities coming back with us, saying, bottom line, the Fed cuts by 25 at the next meeting. It should be a neutral to mildly hawkish 25 basis points as the underlying data away from the unemployment rate based on back-to-back bad months in the household survey is likely to be deemed the outlier. Peter joins us now. Peter, thank you so much for being back with us. I want to get a sense of what you make of yesterday's price action. I know reading the tea leaves of the market can be a fool's errand, but it seemed odd that the initial reaction was to buy bonds, great auction, and then something changed.
You know, I think everyone really has these animal spirits. I think everyone's trying to look through this and say, there is a real chance that Trump cuts a lot of red tape, that he reduces regulation, that he promotes business. I think you're seeing stimulus from the rest of the world. I think at some point we might get worried that the rest of the world is going to slow down enough that it drags the U.S. down. But for now, I think it's just that excitement that kind of all this not in my backyard gets thrown away, and we actually see progress. We see, investment done. We see build-outs here. And I think that's real, and that's what's outweighing even the move in yields.
Well, it might be outweighing the move in yields. But what is behind that yield, that move in yields, given the fact that basically we're counting on a Federal Reserve to cut rates by 25 basis points next week, and you got central banks around the world that are chopping away as quickly as they can?
I think we are not going to see a much lower inflation picture in the U.S. Partly, companies are front-running some, tariff fear, so there's been buying on that. And if we are going to build things in the U.S., which I think there's going to be a push, quite frankly, it's going to be more expensive to do it here than it would be elsewhere. Otherwise, we probably have been doing it here already. So I think there's going to be some costs associated with that. There's going to be a build-out in logistics. We're going to need infrastructure to do all that. So I think it's going to kind of keep inflation a little bit high. You're seeing the data centers grow, all those things. I would say on the equity markets, I see some froth. I'm a little bit nervous, but I think as we talked about earlier in the week, it's really hard to short anything in December, right? The seasonal, factors are in your adjustment. And let's also not forget the amount of money that's been made in crypto in the last few months is certainly helping spur Christmas shopping or holiday shopping. It's doing everything. So, while Bitcoin kind of keeps going up and everyone's excited, I just think that feeds to that overall, we have to buy more of this stuff.
Yeah, I wonder what the housing market in Miami looks like right now with after that Bitcoin surge. Getting back to the central banks of it all, though, on the way up, on the hiking cycle, there was this fear of diverging from the Fed because you want your currency to stay strong enough that you could continue to fight inflation. The opposite is happening now, and you have concerns from different countries about the weakness in their growth. Do you think that this is going to be a divergent cutting cycle, that you're going to see other central banks that want to get out in front of the Fed and have bigger cuts to them and frankly would welcome a Fed that maybe goes on pause in 2025?
Yeah, I think they want to do that. I think they need to do that. Again, Europe is kind of a mess right now, and that Germany, which had been the juggernaut and the anchor, support of everything, they themselves are struggling right now. So that's going to leave the ECB job very difficult. And I've always thought that a big chunk of the tariffs, that if any actually get put on, will be absorbed by a much stronger dollar. And I think that's what we're seeing, right? This dollar strength will offset any of the tariff prices, and that will keep, that pressure lower than it would be otherwise.
You also said something moments ago, though. You said that the animal spirits are dependent on everyone believing weak growth elsewhere won't affect the U.S. At what point does that change?
Certainly probably not this month because everyone's kind of very focused on the holiday season coming up. But I think as you start looking to January and February, okay, how long can we continue? And again, today I think I saw a headline from you that I think is going to be a bigger theme again next year is BYD is now, I think, outpacing Volkswagen in Brazil. And my view has all along been that China's trying to buy time to make sure they can sell their brands globally. So I think we get all excited about this growth and all the stimulus. And I think in the end, we have to be much more prepared for China trying to sell their brands globally, particularly into emerging markets and more Europe. I think the European weakness plays to China.
Right, because if the walls go up on everyone, China's going to have to find a place to dump their exports. When it comes to this idea of potentially where animal spirits are starting to maybe wane, do you want to look elsewhere? Places like China, places like Europe?
Yeah, I actually think the Chinese stock market's somewhat interesting. It sold off after Trump, won, but I think some of that's going to be a mistake because I do believe that they really have to continue with the stimulus. They have to get their things going, and they're going to do everything that they can to help their brands and therefore their stocks. I don't think it's going to be great for global growth. I think there's an opportunity in Chinese stocks as a trade, not as an investment. So I like that. I think around here, commercial real estate, that's become kind of more and more of a theme. I think, work from home is winding down. I think, the DOJ or whatever it's called is one thing. The DOJ is very convinced that, and I think rightfully so, that all federal employees who are still working from home will be pushed into office. So I think you're going to see a resurgence in that. And yields, while they go higher, maybe you get to 450 on 10s with potential spike to 5. You don't go below 4. I think a lot of commercial real estate can do well in that environment.
If you're a traveler and not a settler in terms of the China stock market, how concerning is it for you that Congressman Waltz, Senator Rubio, potential ambassador Jamieson Greer have all called for decoupling of China and the United States?
I think we should be somewhat concerned. Then, on the other hand, Trump supposedly invited Xi to come to the inauguration. So, again, I think everything with Trump is a little bit of a game, a lot of negotiations back and forth. I think it's in China's interest to remain as coupled as possible. I think long-term, we'd probably be better decoupling, but I think we'll get sucked into doing short-term trades that actually favor China over us in the long term.
Can you get into that more? Because you have a really fascinating view that you've been writing about for some time, that Trump could go for what looks like a win with China, but actually gives China an advantage in the U.S.
Right. So we see all the problems that Chinese economy is having, right? And U.S. companies do not want to invest in there. U.S. companies are kind of running their factories at a minimum there. So China, the only way they're ever going to grow is by selling their products. They need to buy time to do that, right? They're struggling right now. And I think they will come up with some deal that looks attractive to us and say, oh, this is perfect. This solves our issues. And then 3 to 5 years down the road, we'll regret it because it'll have given China time to continue to build up their manufacturing, to build up their chip industry, which I think we should be really concerned with. I think when we talk about it from a geopolitical front, it's their chips, it's their AI focus that we need to be worried about. And I don't like any deal that kind of buys them time, takes some pressure off of that, and lets them grow. And that, to me, is the risk, because they've got that longer-term horizon than we necessarily do.
Can we talk about timeline for this? What does a longer-term horizon look like?
You know, I think they can think in terms of decades, but to me, and something like AI and chips, this is a 3 to 5 year thing where they're trying to play catch up. They're aggressively doing it. They don't have access to ASML or some of the high technology, but two things are going on. One, they're able to make smaller chips than we would have thought possible. They make them very inefficiently using old machines to make those, but they are getting those. And then the bigger advances that we're starting to see in the chip industry are coming from packaging and how these chips are layered in the semiconductors. And that technology is actually much easier. So China might be able to actually get some pretty good advancements, even while we're trying to restrict it. And on top of that, we're seeing how easy it is to get around restrictions anyways.
Well, and that's actually what I wanted to ask you. What do you make of NVIDIA expanding its staff in China at a time where there are supposedly these restrictions and they're trying to find ways to maintain their presence and their business in the region?
And I think that's going to be a really difficult thing. And I do think companies like that will unfortunately face some pressure from this administration. I think no matter what Trump would like to do from a business side, I'm a complete believer that some high level of national security has this very high on their agenda. It's bipartisan. And no matter what you might think, once you kind of really get read in on what's going on, what the fears are, I think there will be a lot of pushback to, keeping chips and technology out of China. You look at some of these, the Volt Typhoon, all these hacks have been done to impact our infrastructure potentially. This is a real issue, and I think that's going to be a struggle for all the companies trying to figure out what can be sold into China, because it has to be. And quite frankly, I've heard I think about 80% of the chips we sell into China come back into the U.S. in various products. So it's not an easy answer, but this is tricky. And I think we talked about the other day, China is now starting to try and restrict some of the dual-use chips that have been making their way into the Ukrainian drones. This is going to be messy, and I don't see any way around that.
Peter Tchir, wonderful to talk to you as always. Thank you so much for being with us. Peter Tchir of Academy Securities, and NVIDIA saying that they're going to keep hiring and that they have hired about 200 people in Beijing to beef up a team of researchers. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. The Wall Street Journal is reporting that Hamas has conceded to two of Israel's key demands for a ceasefire deal in Gaza. The militant group agreed for the first time to allow Israeli forces to remain in Gaza after fighting stops, and also handed over a list of hostages that it would release, including U.S. citizens. Israeli Prime Minister Benjamin Netanyahu acknowledged developments in the talks, but said it was too early to tell whether a deal was within reach. President Joe Biden announcing he is granting clemency to nearly 1,500 Americans. Sentences were commuted for inmates placed on home confinement during the COVID-19 pandemic and who have successfully, quote, successfully reintegrated into their families and communities. The president also pardoning 39 people who were convicted of nonviolent crimes. The move represents the largest single-day grant of clemency in modern history. And FBI Director Christopher Wray announcing he will resign before President-elect Donald Trump takes office. Wray said in a speech to agency staff that he plans to resign at the end of President Joe Biden's term next month. Trump, who appointed Wray back in 2017, made it clear he wouldn't keep him on as director of the FBI, even though he's serving a 10-year term that doesn't end until 2027. Trump plans to nominate Kash Patel as the new director of the agency. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, the deficit threat.
I believe the deficit reduction is necessary to keep us on a sustainable fiscal course. There is a threat going forward.
Just a threat that somebody else should deal with, because there's always a sense that it becomes concerning and then you get into office and, one thing leads to another. That's coming up next. This is Bloomberg Surveillance. A little less than an hour until an ECB rate decision as markets in the U.S. take a breather after yesterday's biggest gain, or at least another record high for the NASDAQ 100, led by a couple of stocks. The breadth has really narrowed, and I think that that's important to note. S&P futures off by less than 0.2%. You could see a little bit of dollar weakness, although really it's basically flat on euro dollar at 104.98. 10-year yields, this is what I am watching. 10-year yields now crossing the 430 mark as people look to, if the Fed cuts next week, What does that mean longer term about their ability to cut, given the fact that inflation has been in certain areas pretty sticky? And then, of course, there's the deficit. Under surveillance this morning, the deficit threat.
I believe the deficit reduction is necessary to keep us on a sustainable fiscal course. There is a threat going forward that many of the provisions on the individual tax side, many Republicans have expressed a desire to keep all those provisions in place. CBO said that will cost $5 trillion over 10 years. That would be a blow in the situation.
Here's the latest. Treasury Secretary Janet Yellen sharing her concern over the ballooning deficit, highlighting the potential cost of Trump's previous tax cuts if changes aren't made. Ed Mills of Raymond James writing, on taxes, it is looking increasingly likely that we could see a 4 to 5 year extension versus a 10-year extension. That will keep the cost down and will be easier to pass. Ed joins us now. Ed, it seems like everybody finds fiscal religion as soon as they are on the exit path from any kind of office. How much is there going to be a realization of the deficit by current people who are making a lot of noise around that now, who are going to enter the office early next year?
Yeah, Lisa, something that I've always said is that folks are really concerned about the debt and the deficit until they win the election, because they get in and all of a sudden they want to have other issues and kind of they feel that their team should be the one that wins on policy. And it is pretty rich to have Treasury Secretary Yellen saying that, because you go back and a lot of the fiscal stimulus that has occurred during the Biden administration absolutely was driven by the fact that she was pushing for it. Those Inflation Reduction Act, the American Rescue Plan, kind of pushing Jay Powell on a lot of monetary policy. Those were kind of the economic decisions of the Biden team driven by Secretary Yellen. So her statements there probably gives more boost to Doge versus any sort of conversation related to the extension of the tax cuts.
So you think this just helps the incoming Trump administration for want to potentially find some place to cut some of the spending? When it comes to what we can see, though, at the start of next year, the sequencing of some of these policies under Trump, I'm still trying to understand, Ed, is it going to be one or two packages when it comes to the border, when it comes to energy, and, of course, those tax cuts?
Yeah, Anne-Marie, I think the chair of the House Ways and Means Committee, who's going to be writing this package, wants to know if it's one or two himself. So I think the Senate preference is to have two packages. I think the Speaker of the House's preference is to have two packages. But when I look at the House majority, it's going to start off the year 217 to 215. We've talked about, in that scenario, everyone is king. So getting everyone on board to get to 217 is going to be very difficult to get that done once, not to mention getting that done twice. Now, if there are two packages, Anne-Marie, that immigration, energy, defense package could see a significant boost to spending in each of those areas. If we're living in a world where instead of significant budget cuts to the Defense Department, we're seeing kind of hundreds of billions of dollars in additional funds to the Defense Department, that's pretty interesting. That's very different than the narrative that's out there. I do think that the most likely thing that we see, if we kind of decide one versus two, is those tax cuts will get extended. But as I mentioned, to do it for 4 or 5 years, that's under $2 trillion. To do it for the full 10 years, plus the other things that Donald Trump has talked about, that's where it gets north of $5 trillion. I just don't see House Republicans being willing to support anything north of $2 trillion additional debt over the next 10 years in a reconciliation package.
What gets left on the cutting room floor when it comes to those tax cuts? Things like SALT. Does that really happen?
I think something has to happen, because when you look at it, Anne-Marie, what I've told folks at Raymond James is there are a good number of Republicans still from New York, New Jersey, Pennsylvania, California. And if everyone's king, there's at least a handful that are not going to vote for something unless something gets expanded on SALT. My base case for SALT is what has been proposed previously, which was increasing that SALT tax limit from $10,000 up to $20,000, but having a tax limit on who gets the advantage. Maybe say only households below $400,000 or $500,000 get that additional $10,000 deduction. That scores at about $130 billion. So it's a lot of money, but it's not in the trillions that if you were to waive SALT altogether.
So putting this all together, whether it's one package or two, it's going to cost a lot of money. What's the offset?
So the offset is going to be, one, they're going to say the tariffs are going to pay for a portion of this. That's the political offset. I am skeptical that things like the Inflation Reduction Act are going to be meaningfully changed because of that narrow vote in the House. I do see some money coming potentially through entitlement reform, particularly on Medicaid. I think there's going to be a conversation about some other sacred cows. Is it going to be about closing a loophole in SALT deductions, closing the tax benefits on municipal bonds, taxing endowments? There's a whole host of things. And so what people have to realize that if you're not at the table here in D.C., you're going to be on the menu. And there's going to be a lot of volatility on those offsets. But I don't think you're going to need much more than $500 billion or $1 trillion worth of offsets. It's not the $3 to $5 trillion worth of offsets that people thought you would have. So maybe the pain will be a little bit less than feared.
And speaking of trying to be at the table, we certainly see a lot of tech executives trying to do just that. We learned overnight that Meta donated $1 million to Trump's inauguration fund after not doing that for Biden or Trump's first term. At the same time, we have someone like Andrew Ferguson going to head up the FTC, who has been critical of some of these big tech companies. Ed, put all the pieces together. What do you expect policy to look like in enforcement to some of these big tech companies?
Yeah, so that $1 million donation by Mark Zuckerberg and Meta, that's being at the table. That's a recognition that if you were to continue down the path that policy has been, it's going to be another tough 4 years for big tech. Is there a way to change that conversation? I do think when I look at the elevation of Ferguson to FTC chair, Gail Slater at the Antitrust Division of the Department of Justice, these are folks that are going to continue a lot of the antitrust push that we've seen over the last 4 and 8 years. But there is going to be a subtle shift. Over the last 4 years, we've been focused more on the size and bigness of companies. We've been focused on workforce issues. I think these are individuals that are probably going to go back somewhat towards a consumer welfare standard. Applying a consumer welfare standard to big tech deals is something that was favorable to big tech for a number of years before the move towards populism has come over. How long that lasts or kind of can they get a settlement out of some of the pending litigations? Those are the big questions that I've been getting at Raymond James.
Just real quick, is buying Tesla a policy trade right now?
It seems to be. Elon Musk has kind of done quite well. The run up in Tesla and the fact that you have Elon Musk at the head of a lot of these regulatory changes, potentially being a part of the conversation with China, he's positioned himself well. The question that I get is how long is his shelf life with Donald Trump and who decides that this relationship is over first? It just might be this is so valuable to Musk, he wants to keep it going as long as possible.
And is there someone else in the running to be first buddy? Ed Mills of Raymond James, thank you so much. It seems as though maybe Mark Zuckerberg wants to put his name in the hat for first buddy should the relationship fall apart.
We've seen a few of those olive branches from Zuckerberg. When Donald Trump got shot, he said that was the most badass thing he'd ever seen, and he came up from that. Also, he went and had dinner with him ahead of Thanksgiving, and now he's throwing some money at the inauguration committee.
Yeah, Danny, you make a great point. I mean, honestly, how much you're going to have to see this in order for them to avoid the antitrust?
Yeah, especially with Andrew Ferguson coming in.
Yeah, and the rhetoric talking about trying to enforce that. Coming up next, we're going to talk about the consumer, Holly O'Neill of Bank of America, on the outlook for consumer banking in 2025. Just how much firepower do they have left in their bank account? Cheat sheet, quite a lot. This is Bloomberg Surveillance. About 45 minutes until an ECB rate decision. The expectation widely is a 25 basis point rate cut. Yesterday, U.S. equities hitting an all-time high, at least in the tech sector, not necessarily the S&P today, taking a little bit of it back. 2 hours away from the cash open, here are your morning movers with Manus Cranny. Manus, good morning.
Hey, Lisa, very good morning to you. Adobe, they've got the software for creatives, and they're trying to monetize that more aggressively. And this is where the disappointment comes in this stock. Not only did they guide lighter on the year in terms of revenue at $23.4 billion, it's a wonderful acronym, DMRR, Digital Media Annualized Recurring Revenue, a mouthful. But the point is, they say that's going to grow by 11% as opposed to what you had this year, which was at 13%. So you can try and monetize your AI. You can try and upsell your AI. It's about how much are you prepared to pay as a customer for the additional functionality of AI, that tiered subscription. So this is disappointment all the way around there. Uber, the CFO, was on the stage yesterday at a Barclays conference. Full boat. Still year-on-year growth for them in San Francisco above the US average. And what you've got is tourism. That's autonomous vehicle experimentation tourism going on in San Francisco, which is a nice way to put it. TD Cowen say they're positive, the strategy after the CFO meeting with them. You just talked about NVIDIA. Why are they deploying 200 new people in autonomous vehicles in China? What's Elon going to have to say about that to the president-elect? I'll leave you with a snapshot. It's another upgrade. Constellation Energy, Bank of America. Price target here, $269. Sustained double-digit growth. Compelling valuation relative to their peers and in the best position to prosper. It's a bit like the whole team out there. Lisa, good morning.
Good morning, Menace. Thank you so much. Under surveillance this morning, sources telling us here at Bloomberg that President-elect Donald Trump is scheduled to ring the opening bell at the New York Stock Exchange this morning. Trump, during his first term, often tied the stock market's performance to his economic policy, which raises the question, Anne-Marie, of how much he will do the same this time around.
Exactly. Is there going to be, as what Brian Levitt talked earlier today, and Jonathan always talks about, this Trump put, this idea that this could be a check on some of the incoming president's policy proposals. What we saw, the first iteration of Trump, some stuff would leak out to the press about maybe pulling out of a trade deal, stocks would go lower, and then there would be maybe a phone call between him and President Xi Jinping, or potentially there'd be someone else coming out and saying, actually, we're not thinking about doing that, we're just thinking about getting a better deal. So it's all about the stock market, and I think he's just going to walk in and say, look, my Trump trade, how much richer are all of you because of that?
It's so fitting, right? Like, it is so fitting at the end of 2024, in the middle of this rally, to have Trump. I want to know who's going to be with him, though. I feel like this is going to be another, like, airplane photo op moment to be like, oh, Elon Musk is standing in the background. Who's there? Who's not there?
Well, and who might be positioned where might determine their wealth. Elon Musk becoming the first person to reach $400 billion in net worth. The move spurred by a recent insider share sale of his privately owned SpaceX. That alone boosting his net worth by roughly $50 billion. Danny, raising a question of what the value of having a closer seat to the president really is.
And we see tech companies grappling with this, with Meta donating $1 million to Trump's inaugural fund. I was just looking at the numbers. Every single day since the election, given he's worth over $400 billion now, that means he added $7 billion a day. You could argue that that is the worth of being so closely connected to Trump, because it is Tesla, it is SpaceX, it is all of his companies. It is a really valuable thing, but as Ed Mills was just saying, it's only as valuable as that good fortune lasts.
Right. So the concern is for people who maybe, like Dan Ives, who are putting all this money into and all this hype and optimism into Elon Musk's companies, is what happens if that relationship were to falter. But other executives are taking notice. Look at this from Axios, sitting down with Mary Barra, the GM CEO. She said that federal regulatory framework for self-driving cars, which Elon Musk has been suggesting to President-elect Trump, would be better than state-by-state patchwork. And then she goes on to say, I think there's a lot we have in common. Her and Donald Trump. This was someone who worked so closely with the Biden administration. So the tide is changing, and you see executive after executive in the tech space, auto space now, lining up to try to get a seat at the table.
GM making some other moves as well. Microsoft expecting to take an $800 million charge as GM announces the terminations of its autonomous taxi initiative, Cruise. The automaker citing the high cost of tech development and building out a fleet of vehicles. Microsoft had announced a minority investment in Cruise in January 2021 that was part of a $2 billion investment round. It feels like, Danny, people are assessing what their investments are in tech, which are paying off, and cutting the cord if they're not.
Because so many people had seen the future to be autonomous vehicles. It feels like maybe a bubble is too strong of a word, but something that popped. Maybe popped enthusiasm. I mean, Apple is another case here. They plowed so much money into driverless technology, and they had to completely reverse course too. I was looking at some of the calls. Basically in 2017, every single car and technology company was saying that this was the future, that by the 2020s, we'd have autonomous vehicles on the road everywhere. Uber was saying by 2020, they'd have a taxi service that was a helicopter. I mean, people really got over their skis and spent a lot of money, and now we're taking losses on some of that.
All I can say is I hope that they come up with a taxi service. It's a helicopter. But let's move on. It really does all come down to the consumer and what the appetite there is. We want to really focus on the U.S. consumer. Bank of America releasing its final consumer checkpoint report of the year, saying there were no signs of consumer resilience waning in November. President of Retail Banking Holly O'Neill writing, spending momentum carried across all income cohorts through the gap between higher, middle, and lower income household. Spending growth is narrowing. Holly joins us now. Holly, wonderful to see you. Thank you for being with us.
Good morning.
Good morning. How much power is there left in bank accounts, in desire, in some of the spending trends that you're seeing right now?
Well, as you said, the consumer resilience is not waning. So across all of the metrics that we look at, they look really healthy. And the dry powder is there. So when you look at the money they have in their checking and savings accounts, it's still significantly higher than it was even pre-pandemic. Now, we've seen that come down, but it's still higher. So they still have some cushion in there across all income cohorts, high, middle, low. And in particular, the low income cohorts look even stronger when you look at it on a percentage basis. So from a liquidity perspective, they look strong. From a borrowing perspective, they also look strong. So they're borrowing in and around the same levels that they were pre-pandemic. When you look at our credit card data, so that looks good. They still have borrowing capacity. The credit environment from a bank perspective is fairly normalized. So I think the resilience of the consumer looks strong. And their spending also looks good. And we're obviously in the peak spending period of the year. So their spending looks good. Their spending was up in November. And that matches our data of our surveys that we take pre-holiday. What are you expecting to spend during the holidays? So
well, the reason why I find this so interesting, first of all, is because this has been what has driven U.S. exceptionalism and is the envy of a lot of other countries, but also runs counter to what we're hearing from the guidance of certain retail companies in particular. How do you square that?
Well, I think that the consumer, you do have difference in sentiment versus actual behavior. So we look at the actual behavior of the consumer. What are they spending? What are they spending on? So as I said, spending is up. Holiday period, it's also up. They're expecting to spend $2,100 this holiday period. That's up 7%. So, within that, we're seeing trades to more discount stores. So they're looking to stretch their dollar a little bit more. And they're seeing the benefit of some lowering prices. So in gas, as an example. So in gas, we're seeing a higher number of transactions, but the dollar amount is lower because the prices have come down. So they're making trades within their spending behavior, and they're really making their dollar go further.
How do you distinguish the sort of trading down whole scenario? How do you say that's stretching the dollar versus this is weakness and this is something that might show some cracks?
I think in my opinion, it's the consumer making good choices with the money they have to spend. They're very informed because the overall spending number is higher year over year. But then within that, they're making trades and adjustments. At the same time, their liquidity levels are still strong and they still have borrowing capacity. So all of those things working together, I think, are showing a good, strong, resilient consumer.
The trend has also been this spend on services, airline spending still robust, cruises still robust. Yeah. Do you see that continuing on, or could we have any sort of rotation back into good spending?
I think you could see that rotation. As you all know, during the pandemic, people really upped the ante on the durable goods, the washers, the dryers. We still haven't seen that come back because those have a long shelf life. So I think as you see that mature, you could see it shift back. But the spending patterns really remain fairly consistent. Travel, experiences, services, those are very strong. We are seeing in this holiday spend, we are seeing electronics come back a little bit. So that's also, a beginning trend, I would say.
Speaking of the holiday season, a lot of retail analysts have come on and said they're really focused on the fact that there's 5 less shopping days because it's a shrunk, basically, holiday season between Thanksgiving and Christmas. Do you see that having any impact at all on consumers willing to spend?
No. I think overall the consumer is going to spend for the holidays. It is a more truncated period, but we adjust for that when we look at the behaviors. So for the 2 weeks around Thanksgiving, and it was late this year, right? I think it's as late as it can get. We did see that spend go up. And so I think it's just going to be a more truncated period.
What would you be looking for if you see any cracks of this resilience?
I would look to their spending patterns first. Again, borrowing, we will always look at as a bank, but the borrowing behaviors are still really strong. They're still paying credit cards off at a pace that's faster than it was pre-pandemic. That's a really good sign. And then the liquidity in their checking and their savings accounts. And, I think we've seen that really kind of flatten a little bit. And as we get into 2025, I would expect to see that start to grow again.
I'm trying to build on what Amaru is talking about. There seems to be a disconnect, and please help us with this. Because on one hand, in this survey, you talk about the gap between the wealthiest and lower income cohorts narrowing actually marginally. Mm-hmm. You talk about a robust firepower in their bank accounts. You talk about ability and willingness to borrow. And then you talk about looking to stretch their dollar. This kind of behavior that you typically see on the brink of something that does feel like, to Danny's point, a weakening. So what gives? Why aren't people spending more in a traditional and freewheeling way when the data seems to suggest they'd be in a position to do so?
I think that we've seen a permanent shift in what the consumer wants as a liquidity position in their account, right? So I think they got used to that during the pandemic, saying, I have more cushion in my bank account and I'm going to keep that there. And then they're making the trades into lower cost goods to make sure they keep that and maintain that level. So, I think that's one of the trends. But I think it's the consumer who is very educated, very aware. There are deals everywhere. They're in social media. We know that 30% of our clients are planning to buy in social media this year, which is very interesting. And so I think they're very aware and very informed and making choices.
Is that the same thing as price fatigue? Because we've heard that a lot among companies, that their margins, they can't keep expanding it because there's fears that people aren't willing to pay up. Is that the same a different side of the same coin?
I think it could be, yes. And I think, it's consumers, again, making very informed choices and taking control for themselves as to where they can spend their money, where they can budget.
Holly O'Neill of Bank of America, thank you. This was really, really interesting. Holly O'Neill there with us at a time 30% are going to buy on social media. Danny, that was actually pretty stunning to me.
It's huge, and it also speaks to why companies like Macy's are struggling, because fashion trends are happening so quickly now that they're happening on social media. And if you're a company and you haven't kept up with that, you haven't adapted your brand, you're going to struggle because people demand something very specific now.
I only have done that once, social media buying, and to be honest, I really didn't like what came through, and now I never do it.
Yeah, well, I don't think that we're the target demographic from the experience I've seen in my household with some of the younger folk. Right now, let's get to an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Hackes. Yahaira.
Hi, Lisa. South Korea's opposition has filed a second impeachment motion against President Yoon Suk-yeol. The motion was filed after Yoon made a defiant speech in which he tried to justify his martial law declaration last week, insisting he would fight any case against him. If the motion is successful, a court ruling will determine whether Yoon will be forced out of office. That would lead to a presidential election being called within 2 months. Now the latest on the investigation into United Healthcare CEO Brian Thompson's murder. New York Police Commissioner Jessica Tisch said the 3D printed gun that Luigi Mangione had when he was arrested this week matches 3 shell casings found at the crime scene. She also said a crime lab was able to match the person of interest fingerprints with those found on both the water bottle and the kind snack bar found near the scene. Mangione remains in custody in Pennsylvania. And Meta donated $1 million to President-elect Donald Trump's inaugural fund. This part of an effort for the tech giant to build a positive relationship with the administration. Meta owns Facebook and Instagram, both platforms Trump was suspended from after the January 6th insurrection, though Trump's accounts were reinstated in 2023. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira, and I just got schooled. It's not an age thing. It's just a coolness thing, I guess. Up next, the Fed's balancing act.
Right now, I'd say the inflation story is still benign. When the Federal Reserve looks at it, they're going to have to look with one eye on what's really going on in the economy right now and one eye on what might be coming in terms of policy.
That's coming up next. This is Bloomberg Surveillance. Less than a half an hour until the ECB rate decision, and then 15 minutes after that, we get PPI for components that are going to be put into PCE, the alphabet soup of inflation that we talk about. And of course, initial jobless claims. Key question will be, how much do people feel like longer term yields are going to stay at these levels? Under surveillance this morning, the Fed's balancing act.
Right now, I'd say the inflation story is still benign. It's cooling very slowly, but it's still cooling. But the question is, what are we going to do to that when we attack this with policy changes next year? When the Federal Reserve looks at it, they're going to have to look with one eye on what's really going on in the economy right now and one eye on what might be coming in terms of policy. This is a really good economy for financial markets. The question is, can we sustain it in 2025?
Here's the latest. Traders expecting the FOMC to cut rates at their meeting next Wednesday, but a slew of unknowns weighing on the outlook for growth and policy in 2025. Michael Collins of PGIM writing, economic growth in the U.S. remains outright strong, but we still believe growth will moderate due to most consumers running out of discretionary income. Interest rates will remain restrictive, and much of the rest of the world is struggling. Michael joins us right now. Mike, thank you so much for being with us, and welcome. I've been trying to make something of this, and everyone's been shutting me down, but I want to get your take on this. Yesterday, I thought the price action was really interesting in bonds. We had a rally when we first got CPI bang in line with expectations, and then a sell-off in the long end as people started to worry about next year. Did you take any signal from that?
I think the markets are confused, just as the Fed is, about the data. You know, as Mr. Kelly just said, I mean, they're looking at the current environment, which is really strong, right? I mean, if you look at all the GDP expectations, we're kind of poking toward 3% here on a pretty consistent basis, Lisa, right? And inflation obviously has kind of been running a little higher than the Fed's 2% target. So, I mean, you know, all else being equal, the rate today at 4.30 feels like it's fair value for the current environment. But remember, the Fed and the markets are supposed to be forward-looking. So what is the world going to look like in terms of growth, in terms of inflation, in terms of the fair value of interest rates in a year and 2 years from now? And that's where I disagree that the current environment isn't really sustainable and that eventually the rate structure will be lower. But for now, it's hard to argue with rates at these levels.
What gives you confidence about that, Mike? And I would just follow on, how much conviction do you have on this to be buying with both fists at a time where everyone else is saying, oh, we could see 5% again?
Yeah, I mean, I just don't think that is sustainable. That level of interest rates is, as you just saw in that summary, Lisa, is just too restrictive. And the Fed gets that, right? They understand that rates are really restrictive now, that a real rate, I mean, the real funds rate, you could argue, is, you know, probably 2% right now, which is, 150 basis points above where the Fed has previously said the fair value real rate that our star is. So they're very restrictive now, and it is biting, right? It's biting consumers, and you're talking about consumers trading down in your last segment, and that is happening in a big way. Our retail analysts are seeing it. I mean, 2/3 of all the sales growth in retail sales right now are coming from Amazon, Costco, and Walmart. I mean, if that's not telling you what consumers are doing with their pocketbooks, I mean, that's a real strong signal, I think, of the pressure, the pushback on this high level of prices. So,
Mike, if I can just jump in on that point exactly, because Lisa and I both asked Holly O'Neill of Bank of America about that and said, how for you is that not sign of cracks? And she said, because the overall spend is higher. It's just consumers that want a liquidity buffer in their bank account. It's not weak consumers because they're spending more, delinquencies are falling, and the spending gap between high and lower income consumers is actually shrinking, and they look incredibly healthy. What do you say to that kind of data?
Yeah, I mean, the wealth effect has definitely helped, and it's not just housing and the stock market, but, increasingly younger people have owned things like Bitcoin and other cryptos, which makes them feel wealthier. But I think it's a big difference. There's a big difference between the average household, which is generally what the economic data portray, versus the median household. And I really believe, Danny, that there's this huge cohort, maybe 80% of the consumers in this country that are really struggling. I mean, I have, 3 kids in their 20s, and I think their average bank account has $0 in it, right? And I don't think that that's not representative of the broader economy of young people who've really been hit hard by higher rents, higher insurance, higher food prices, higher auto prices, you name it. It's brutal. And I think all of those things are going to bite. They haven't yet, but I think over time, that those higher rates start to bite, and I think the Fed will have to capitulate at some point. And I don't think it's going to be next week's meeting. In fact, I think those dots will probably come up in terms of the amount of rate cuts the Fed expects for next year and maybe even into 2026. But I think ultimately the average funds rate over the next 10 years is probably going to be a lot lower than what's priced in today.
Sounds like a difficult time to be Bank of Dad at this very moment, Mike, so my sympathies go out to you. But there is this feeling right now that the animal spirits have been reawakened and that there's positivity among companies, that they want to do more CapEx, that M&A, a wave is coming back and deals are going to be flourishing in 2025, that something's going to be happening and something will be in the water that reignites inflation, whether it be that or whether it be policy linked to tariffs and linked to tax cuts. Could that possibly outweigh some of the fears that you're speaking of?
Yeah, that's all possible for sure, Dan. And in the near term, that's what's being priced in, right? In the near term, the markets are pricing in a continuation of this really strong economic growth outlook, a continuation of the sticky inflation, a continuation of these restrictive or really high interest rates. That's what's priced in right now. The markets are pricing in a funds rate that gets down to 3 5/8 and stays there forever. Right? Could that happen? Absolutely. Could that be the environment we remain in for the next 12 months? Absolutely. But as long-term bond investors, on behalf of our clients, Danny, we're looking at, the 10-year yield at 4.30 today, and that's supposed to be the average of the funds rate plus some term premium over 10 years, not over 1 year or 2 years, right? So we're always trying to take a long-term perspective on maybe which way the market's leaning and whether that's right or wrong. And right now they're leaning to this real persistence, this extrapolation of the current environment continuing to be really robust. And that's where I have my doubts.
Mike, we just have about 30 seconds. Are you basically buying long-term treasuries and selling lower risk credit?
Absolutely. That's the trade, right? You add duration on backups here. We've been pretty consistent probably for the last 12 months on this, Lisa, as the rates back up toward what I think the high end of the range is, which is closer to 4.5. I get excited. Our clients get excited, and we're certainly advising them to add duration at those levels. And as spreads keep ratcheting tighter, even though you will have credit risk increasing across the macro climate, you're supposed to cut credit risk, right? So those are the big two themes that we're certainly instilling in our portfolios.
Mike Collins of PGIM, thank you so much for being with us. It's always illuminating. Coming up next hour, Anastasia Amoroso of iCapital, Sam Zief of JP Morgan Private Bank, Dana Peterson of the Conference Board, and Scott Chronert of Citigroup. You're watching Bloomberg Surveillance.
The inflation story is still benign. It's cooling very slowly, but it's still cooling.
We basically now live in a 2% inflation world rather than a 3% inflation world.
You're still running at 3.25%. That's still well above where the FOMC wants to see it.
Consensus is that we are on a downward inflation trend. The Fed does not seem worried about inflation being a little sticky above target.
For the moment, U.S. exceptionalism is a story that's really, really hard to push back on.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back. 90 minutes to the start of the trading day in New York, and all eyes turning to Europe. ECB rate decision coming up in 15 minutes with the broad expectation of a 25 basis point rate cut following significant rate cuts from the Swiss National Bank and the Bank of Canada. Markets pulling back a little bit after yesterday's gains, snapping a 2-day losing streak. And yesterday we saw the outperformance in big tech. Today we are taking it back. Nasdaq 100 futures down, leading the declines lower, down 0.4%. Really, the key is going to be, Danny, how much can other central banks outside of the U.S. front load some of those rate cuts to get ahead of the uncertainty uncertainty of 2025.
It does seem like there's a desire at this moment to decouple from the Fed. We're talking with Peter Tchir about this, that on the way up, you saw different central banks wanting to stay in tune with the Fed because they didn't want to let their currency weaken. They needed a stronger currency in order to battle inflation. It's completely the opposite this time. The S&P is explicitly saying that they're cutting 50 basis points in order to weaken the Swiss franc. Are you going to see something similar from the ECB, that they want to get out ahead of not just the Fed, but of incoming President Donald Trump?
And this is the first decision as president of the S&P, and not only cutting rates, but saying potentially we could go negative if we have to, because negative rates do work. All of this a reaction ahead of potentially, to Danny's point, what comes down next year. The rhetoric coming out of the Trump administration, a more protectionist America. S&P, ECB, they're going to have to find a way out of it.
Which raises the question of how much is this time going to be different than 2016, given the fact that you have companies and countries trying to get out ahead, with the reactions coming before even President-elect Donald Trump takes office, Danny.
Yeah, I mean, they have learned the lessons of 2016, of 2017, and thereon. They learned that it can be useful to be transactional, not only as a country, but as a company, too, that if you want to escape the broad wrath of tariffs, you need to be someone like Tim Cook, who goes and meets with Trump and tells him how horrible it is to have tariffs on iPhones coming out of China. That maybe is the only way to escape, and they learned that lesson.
And we're going to be closing out this year and starting another year where we're going to talk all about all of those maneuvers. Coming up this hour, Anastasia Amoroso of iCapital. As stocks snap a two-day losing streak, Sam Zief of JP Morgan Private Bank on the Fed versus ECB and the divergence we're seeing there, as well as Dana Peterson of the Conference Board reacting to PPI and, of course, initial jobless claims. We begin this hour with stocks steady, the Nasdaq hitting a fresh record high. Investors digesting an inline CPI print, all but guaranteeing a Fed rate cut. Anastasia Amoroso of iCapital saying even if the Fed slows or stops their pace of cuts in 2025, there should be 100 basis points of relief by this December from the 5.5% level seen earlier this year. That is already meaningful. Another 50 basis points, the current market expectation, would help more. This should support growth, stay with the positive momentum for equities. Anastasia joins us now. Anastasia, wonderful to see you. Thank you for being with us. Good morning. I'm just wondering how much these rate cuts are supportive at a time where maybe rates are not as restrictive as some people think.
That's right. Well, they are certainly working their way through the economy in terms of the rate cuts. And when we came into this year, we wrote about the sizing of the U.S. debt piles in the corporate market and consumer market and the U.S. government. And we were thinking about these floating rate exposures that were a concern. But the opposite of that is happening today. And what I mean by that, private credit, for example, if you're a private credit borrower, if you're a leveraged loan borrower, you are paying an exorbitantly high interest rate. And you are starting to see some relief because those coupons are resetting lower as we speak. If you're a consumer that may be carrying a floating rate balance on your credit card, you're also starting to see some pullback there as well. And so the more this happens, the more months occur, the more relief actually accrues to the U.S. consumer, the corporate, and also the real estate operators. And that's just to start. If we do have another 50 basis points next year, the rate relief is that much more.
Especially at a time where the rate cuts elsewhere are so significant. We're about 10 minutes out from an ECB rate decision. The expectation is a 25 basis point rate cut. I just wonder how much the fact that international capital has been piling into the United States, also seeking yield, seeking economic growth, how much that turbocharges the trends you're talking about.
I mean, it certainly does help. And look, the 10-year Treasury yields have been incredibly sticky, partially because of strong growth in the United States, partially because of the concern about the budget deficits, and I think partially because the economies elsewhere are fairly weak and rates are being cut. So I think that will send flows back into the United States. By the way, next year, we were talking about this, is likely the year of protectionism, is likely the year of America First policy. So I think that, too, Lisa, is going to send flows to the United States, or at least keep them coming here.
If you would have told someone that we'd get that America First policy, that by the end of 2024, we'd have 75 and now 100 basis points of cut with December, once we get that, you would have said, okay, it's going to be a huge month for small caps. Small caps will be off like a rocket. You saw that in the beginning post-election. But since then, the rally has really started to concentrate again. It's been the Mag 7. It's been the tech players. Breadth has been negative over the past 8 trading days. Is this a sign that the small cap trade might not play out as expected in 2025?
No, I don't think so. I think what's really happening is that investors are being very active in terms of their exposures, and there's definitely some trading that's starting to take place right now, and they're chasing the near-term laggards, and they're selling some of the near-term winners. And I think that's what happened after the election. You've seen this great month for small caps. You've seen a great month for regional banks and financials, and then you took a pause with that, and you look to big tech, for example, and the fact that it's lagged, the semiconductors, software, and all of that right now is having a catch-up moment. So I think it's about a series of those rotations. But no, I don't think investors have given up on the fact that it's going to be domestic economy first in 2025, domestic revenues first. But I would probably broaden out the small cap trade and just say prioritize companies that have a high share of domestic revenues, whether they're small, medium, or large. And if we are going to end up with an environment, I call plenty of wildcards in 2025, that we talk about tariffs before we talk about tax cuts, that probably does have a few risk-off moments. So maybe small caps is not the only place you want to be. You want to be in a high share of domestic revenue companies that maybe have the quality tilt to them as well.
If you're worried about tariffs and domestic policy, is it useful to stock pick depending on what CEO is reaching out to Donald Trump, depending on who's down at Mar-a-Lago?
Well, that might be a factor, yes. So some managers will choose to incorporate into their models. But I do think next year is all about the dispersion of sectors, factors in different stocks. And, I think you want to be positioned in parts of the economy that are growing and also have a high share of domestic revenues. Obviously, engagement with the administration is also a good thing. So that's why we're looking at financials, we're looking at regionals, we're looking at utilities. We're also looking at software stocks, for example, relative to the semiconductor stocks. And, speaking of, chasing laggards, right? Semiconductors have had a stellar year in 2024 and also 2023. But I think some rotation into the domestically tilted software makes a lot of sense now.
Well, building on Danny's point, I guess the question is, do you expect this administration to do what they've done in the prior when they were in power, which was for some companies, you're going to have to offer carve-outs?
Yeah, I think it's definitely a possibility. And, Anne-Marie, I would say, the title of our outlook for next year is solid underpinnings for the U.S. economy and plenty of wild cards. And the truth is, we just don't know which wild cards we're going to get. And the wild cards that I'm thinking about are tariffs and taxes and budget deficits, as well as the direction of Fed policy and also the direction of big tech regulation. And the truth is, we might get an administration that imposes the unilateral universal tariff, or maybe they have a threat of it, or maybe there's an agreement that actually gets negotiated in the process of it and does it very quickly. We don't actually know what the ultimate outcome is going to be. And so that's why for investors, I think it's really important to stay pro-risk, to stay pro-growth, to stay pro, solid economic environment, but just recognize that the range of outcomes is going to be wider.
Anastasia Amoroso, happy holidays. I think
happy
we can say at this point.
Lisa.
Thank you so much for being with us. We really appreciate it. As we count you down to an ECB rate decision followed by PPI and initial jobless claims. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. President-elect Donald Trump tapped Kari Lake, a former TV anchor, to be the next director of the federally funded broadcaster Voice of America. Lake, an ardent Trump champion, ran unsuccessful Senate and gubernatorial campaigns in Arizona. Voice of America provides news in more than 40 languages to audiences around the world. Meanwhile, Bank of America promoted 387 employees to managing director, 16% more than last year's total. The promotions are according to people familiar with the moves. More than half of those elevated to the senior role were women or people of color, marking the 5th year in a row that historically underrepresented groups made up the majority of the class. And former New England Patriots coach Bill Belichick is moving to college football. The Athletic reporting that Belichick and the University of North Carolina have agreed on a deal worth $50 million over 5 years. The deal makes the 72-year-old one of the highest paid coaches in the college game. In Belichick's 24-year tenure at the Patriots, he won 333 games and 6 Super Bowls. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. I think we're going to leave that story right there. Up next, the ECB rate decision. We'll have the details and get the reaction from Sam Zief of JP Morgan Private Bank. That's next. This is Bloomberg Surveillance. little more than a minute ahead of that ECB rate decision. The broad expectation is for 25 basis points of cuts, with possibly a dovish inclination as to moves coming out next year. Right now, state of play in the U.S., what you can see is a sell-off building in the NASDAQ 100 futures, down about 0.4% in the yield space. And this is actually pretty interesting. In the U.S., you're seeing things inflect higher. In Europe, it's actually significantly lower as we look to potentially lower rates by the ECB. The Swiss National Bank coming out earlier this morning, and Danny, not only cutting by a half a percentage point, but also with the new head of the SNB saying, actually, negative rates, no one likes them, but they work.
If your rate right now is at 0.5%, you need more firepower, not just for now, for the economic weakness coming from a weaker currency and a weaker general environment, but for what might happen in 2025. They want to make sure they have the ability to grapple with whatever comes, be it tariffs or just further political and economic weakness in the region.
Which is the reason why I'm curious to see what the rhetoric is. ECB decision, I expected the headline, but with respect to the future guidance, very curious to see how much they signal and a willingness to allow some sort of a negative rate policy. We are still waiting for those headlines. The expectation is for a 25 basis point rate cut, and you get that 25 basis point rate cut to 3%. That was the broadly expected estimate. They're not pre-committing to a particular rate path. They're expecting to lower the three key ECB interest rates by 25 basis points. I'm curious to see what the breakdown is going to be. This is the key. They are determined to ensure that inflation stabilizes sustainably at its 2% medium target for inflation in the region. Key question is, how much are they going to counter weakness? They do see 2025 inflation at 2.1%. The prior expectation was 2.2%. And 2026 inflation, they're keeping at about 1.9%. Anything standing out to you, Danny, that really gets your attention in any of these headlines?
Well, it's just, an ECB that has a single mandate, that cares about inflation. And again, these lines really just go to speak to that, saying that they're determined to get inflation stabilizing sustainably at 2%. The fact that they didn't change their outlook for 2026 inflation. Nowhere, at least on these headlines so far, do you see an ECB that's ready to really pump up the firepower and get cuts in there and to really support the economy at this point?
Lizzie Burden right now joining us from Frankfurt of Bloomberg. Lizzie, so good to see you. What do you notice from some of the commentary and the breakdown of the vote?
Well, look, we were expecting this quarter point cut from the ECB to 3%. The hawks weren't going to be backing a 50 basis point move when you had this rise in negotiated wages in the third quarter. It isn't that long until the next ECB meeting when, of course, Donald Trump will be back in the White House and there should be a bit more clarity on the tariff threat. Of course, the euro area very much in the firing line. So the focus was always going to be on the path ahead here. What's interesting is you've got the updated forecasts, as you say, and a slight downgrade to inflation this year. They had seen 2.5%. Now they see, they have downgraded the inflation forecast slightly. And indeed, at the last press conference, Christine Lagarde had said that the inflation risks were tilted to the downside. So this revision, not a surprise. We'll also be looking ahead to the press conference. I am sure that Lagarde is going to be asked, as a French woman in Germany, about the political hurdles, shall we put it mildly, in France and Germany and the impact of the fiscal tightening potentially on the ECB. If there's less fiscal tightening, does the ECB have to do more work? I'm sure that she'll be asked whether 50 basis points was on the table at this meeting, and also about the neutral rate, because there's surprising alignment between the hawks and the doves on the Governing Council about the need to get to neutral. The question is where neutral lies.
And Lizzie, you are seeing a reaction. The euro is weakening 0.2%. This also just crossing that the ECB has dropped their reference to restrictive from their statement. How much of this might be a win for the doves, that the balance of power maybe is shifting to them, Lizzie?
This is a dovish tilt, Danny, and it's what we expected as well. Previously, the language had said that they were going to keep rates sufficiently restrictive for as long as necessary, and therefore it is a dovish tilt that they have changed that language here. It is what we expected, given that the picture had darkened, both in terms of inflation and growth since the last meeting, not least because of the political collapsed governments in France and Germany, but also with the return of Donald Trump to the White House and the continued problems, the economic weakness in Germany, the second straight year of contraction there, and the wars in Ukraine and the Middle East as well.
Lizzie Burden, great work as always. Thank you so much for being with us. That's Lizzie Burden of Bloomberg. Joining us now from JP Morgan Private Bank is Sam Zief as he sits here and watches all of these headlines cross. Sam, what's your impression?
I think you guys have really nailed it. All of these central banks, between the Fed, the S&B, and the ECB now, are trying to ensure that inflation stabilizes at 2%. But how they're going about it is completely different. The Fed is thinking about how do they inch down towards neutral, keeping policy restrictive enough because the economy is in a really good place and they don't want inflation to reaccelerate. Where I would argue that the S&B and now the ECB with the drop of restrictive in the terminology is actually just arguing, well, how far below neutral might we need to go to ensure that inflation stabilizes at 2%? And that divergence between what we're seeing with these major European central banks and the Fed is really what underpins our view in FX that the dollar is going to be strong, particularly against these types of currencies.
Does it go far enough? Because Robin Brooks of the Brookings Institute has been arguing that Europe desperately needs a weaker euro, that you're not going to get instituted anything that Draghi outlined of Europe coming together and spending more. The budget standoff in France shows that they have very little fiscal room. And because of that, they should be decoupling from the Fed at this moment and be doing larger cuts. Yep. Do you think there's any credence to that argument?
Yeah, I mean, whether it's because I don't know if a weaker euro is going to actually spur innovation and investment, which is what that Draghi report made, but clearly the economic trajectories are very different. The Fed's or the US's is arguably tilted to the upside. The economy is in a really strong place. European economic outlook is definitely tilted to the downside when it comes to growth. I don't think the euro is the main policy tool there. I think it's interest rates. But there's room to lower interest rates. There's room to move further into accommodative territory. That's going to be the ECB's priority. The euro is the knock-on effect, and it's going to end up in a weaker euro. But really, it's going to be the rate channel that they focus on.
We do see the euro dropping after this decision below 1.05 against the dollar. Do you see parity next year, given the fact that it's a weaker growth environment in Europe? And on top of that, they're dealing with a Donald Trump administration.
We definitely wouldn't rule it out in the private bank. The lower end of our kind of euro range that we're looking at in 2025 is 102. But, as an FX strategist, I know the difference between 102 and parity is, going to a few days, let's say, of trading. So a test of parity is definitely something that we're not ruling out. And definitely one of our high conviction views that we're talking about with our private bank clients is being underweight European assets, favoring the dollar, being short euros, funding in euros, all of these things that benefit from the same thing.
Given the political paralysis we're seeing in France and Germany, given the fact that they are dealing with a tougher environment in terms of potential trade wars in 2025, the ECB is saying they're going to follow a data-dependent meeting-by-meeting approach. Is that correct? Or do you think Lagarde, when she comes out and gives her rhetoric and answers questions, she's going to tilt more to the dovish side?
I think the most interesting thing from the press conference that I'm going to be watching is, so they've gone by 25 basis points today, but the market is still pricing in about a 30-40% probability of a 50 basis point move at some point, either in January or in March. Whether that there's some nod to the fact that that could be on the cards, they've so far been fairly, let's say, cautious in guiding against a 50 basis point move. But I think because that market pricing is there, it's going to be really important to watch whether they endorse that type of probability or possibility. And then that's going to be how I take up the press conference, to be whether they're moving in a more dovish direction or not.
Should we be talking about negative rates again, like the S&B is?
So I would say that what they said, just to be clear, is that, as you said, no one likes them, but they're there and they work, particularly for a country that is really using, let's say, the currency as their main tool for monetary policy. I don't think that the S&B is going to go back into negative rates unless the ECB kind of forces them, right? Think about when they went into negative rates last time. It's when the ECB went negative, the S&B felt like they needed to respond. I think that would take not just economic weakness in Europe to get the ECB to think about that, but really, whether you want to call it a crisis or a really deep recession, if that comes to fruition, I have no doubt that that negative rate tool option is there in the European Union. They've used it before.
Just to underscore that, the ECB dropped the reference to keeping rates restrictive in this latest memorandum, in this latest rate decision. How big of a shift is that, just to underscore, in their rhetoric, in their approach, when previously they've been talking about inflation as really the preeminent concern?
Yeah, I think this is definitely I think everyone knew that they were going back to neutral. The market was already pricing some probability they'd go into accommodative territory. But I think this really crystallizes the break between the ECB and the Fed. and that the Fed is still talking about keeping rates sufficiently restrictive to ensure that they bring inflation down from the high side, where now the ECB is officially basically endorsing that they're going to need to go not only to neutral, but maybe below, and that's how they're going to stabilize inflation.
With this divergence potentially widening, at what point do we have to worry about a strong dollar becoming an actual disruptive force in global markets?
So it tends to be not just the strength of the dollar, but the magnitude of the moves. It's when you get really multi-standard deviation moves over a month or two or three that you start to see other central banks, whether they be in emerging markets or others, start to respond, whether they be through outright FX intervention or trying to, not cut as much as maybe the market is pricing. I don't think we're there. The dollar's not as strong as it was in the second half of 2022. It's not as overvalued either. And I think, again, the dollar is just kind of the byproduct of this divergence. And so, at least at the private bank, we're continuing to lean into it. We don't think that this trip is over.
Sam Zief of JP Morgan Private Bank, thank you. Other people are probably going to say the trip to Europe probably isn't over as well from the United States. And what we're seeing right now, just to reiterate, if you are joining us, the ECB did cut by 25 basis points as expected. But really, Danny, the rhetoric going forward is what's catching a lot of people's attention.
Exactly, because they had in their statement in the past that they were keeping rates sufficiently restrictive. They've now dropped that from their statement. And I think Sam so rightly points out that this is the divergence. They might be cutting 25 basis points, much like the Fed is expected to, but they're leaning dovish in a big way that shows that they are now trying to support the economy versus dampening inflation down.
And Sam's right. The rhetoric when Christine Lagarde comes out, it's going to be about, is she leaning towards maybe doing this sooner, January, for that 50 basis points, or is it going to be down the line in March? Are they going to try to maybe get ahead of some of the tariffs coming out of Washington, D.C., or are they going to wait to see what Trump does maybe in this first month or 2 months in office?
Divergence, definitely the theme of the year and theme heading into next. Coming up next, breaking down PPI as well as jobless claims here in the United States. The expectation for ongoing resilience, the strength, this idea of how much inflationary pressure is this as we talk about the potential for negative rates in Europe. Dana Peterson of the Conference Board and Scott Chronert of Citi, both here to react. About 25 seconds until we get PPI as well as initial jobless claims. Here's the state of play in markets. We're seeing equities just basically pull back a little bit from earlier lows, but still lower on the day after yesterday. NASDAQ futures, NASDAQ closing at all-time highs. We are expecting here for PPI final demand year over year to be 2.6% versus 2.4% in the prior reading. Maybe this is why yields are inflecting higher. Let's head over to Michael McKee, the Bloomberg Economics and Policy correspondent who has all of the numbers. Mike, what do you see?
Well, this is a bit of a disappointment for those who are hoping the Fed doesn't move interest rates, or actually hoping the Fed does move interest rates, because inflation comes in faster in the PPI than anticipated on a headline basis, up 0.4, which pushes the year over year to 3%. Remember, you were just suggesting that the consensus was for 2.6, so this is a big jump over 2.4 last month. Core comes in up 0.2, which is what was forecast. That's down from the 0.3 in the month of October. And the core minus trade services as well is only up 0.1. So you put those all together, and it isn't as bad as that headline number sounds. We'll have to see what pushed that up. On a year-over-year basis, final demand, as I mentioned, 3%. Food and energy core, 3.4%, up from 3.1%. And ex-food, energy, and trade, 3.5%. Now, jobless claims, here's an interesting one. 242,000 jobs, a big jump in jobless claims after 225 the week before. So there is a case here for weakening in the labor market that perhaps the Fed wants to take a look at when it considers whether to cut rates or not.
Mike, I'll let you dig through some of the details right now. Here's what you're seeing in markets. Kind of interesting. Seems like bond traders are taking more of their tell from initial jobless claims than they are from the inflation read across PPI. Yields lower across the board. On futures, you are seeing an extension of those declines, but the yield space is what I have my eye on. Two-year yields actually now lower on the day to 4.15%. Again, initial jobless claims coming in at 242,000 versus the expectation for 220. What you can see across the board, ongoing dollar strength, but it's not because of the U.S. side of things, and that is the interesting aspect. This is about it being worse on the other side of the pond, but lessening some of that dollar dominance that we saw immediately after the ECB rate decision. Mike, just want to get your thoughts on why we seem to be seeing a market that is focusing much more on the jobless picture and initial jobless claims than to the fact that PPI came in significantly hotter than we previously expected.
Well, the market is looking at what the Fed might do, and the Fed has talked about its concerns about the labor market weakening as their major sign of weakness in the overall economy that could be coming. So they're going to react to labor market data more than they will to perhaps inflation data. And of course, PPI doesn't translate specifically into CPI. And this is just the headline number, and there is a very good reason for it. And I know Anne-Marie's going to be interested in this. According to the Bureau of Labor Statistics, the jump in the headline number was 80% because of final demand foods. And as far as that is concerned, 54.6% jump in the price of eggs. Now, remember what Donald Trump said the other day. He was elected because of the price of eggs. We saw a little bit of this in the CPI, but that's a rather huge jump for egg prices.
Thank you, our chief egg correspondent, Michael McKee, for that update. Joining us now is Dana Peterson of the Conference Board. Dana, I just want to get your take on what we're seeing right now, which is definitely signs that inflation is sticky in the United States. But this 242,000 initial jobless claims, should we be concerned?
I'm not sure about that. It's one number. We need more data. And certainly 240 is still very low. Very few people being let go. Companies are not looking to let people go, at least when we ask the CEOs of the largest firms, and that's because they need those people. They're also paying higher wages. So I don't really see a labor market right now that's weakening. And even in the payrolls data that we did see, it was all mainly very good.
Dana, unfortunately, I feel like this is becoming an evergreen question. But just looking at today's data, the data we've been getting, how much is it distorted? How much can we trust the data? Are we still working through some of these weather effects, some of the strike effects, things like that?
I don't think so. I think we're beyond the weather and the strike effects. And it's important to kind of dig beneath the surface and see which states popped in the week. And again, we could see reversals in the next week. Jobless claims, you really need to look at the 4-week moving average. When it comes to inflation, a lot of the egg inflation is because of the bird flu. It's not necessarily because companies are trying to get away with something. It's really just this external shock. But absolutely, inflation is sticky. We saw that in the CPI data. Some of it's structural. You have fewer people working because they're retiring. That's raising wages, and that's following through in inflation. Insurance costs are rising across the board. And also shelter costs are not falling as quickly as you would expect. So all those things are keeping inflation sticky.
So putting the idiosyncratic story around eggs specifically, the fact that PPI final demand, though, is higher, are you more concerned at this point with inflation or the labor market?
I'm more concerned about inflation. Again, the labor market seems to be doing well. Even when we have bumps and bruises, it comes back. Most people are working. The unemployment rate's super low. The number of people who are saying they're unemployed, many of them are actually new entrants or returning to the labor market. And you wouldn't do that if you felt that the labor market wasn't strong. But I think the main issue is inflation. You have these structural factors and these supply shocks that are driving inflation higher, things that the Fed can't really lean against. And certainly when we head into next year, we could have shocks from either trade or fiscal policy that could cause inflation to be even higher. And the Fed's going to have to lean against all of that.
Well, Dana, one thing that I know you know very well is that sentiment has really started to shift. And we know how closely a lot of the sentiment is tied to the political environment. Previously in the Biden administration, you had this mismatch where hard data was strong, the soft data was far behind it. The soft data just did a 180 to catch up with where the hard data is. Does that mean it's just reality is more closely aligned, things now make sense, or are you all of a sudden going to see this big change in behavior in both consumers and companies?
Well, our measure of consumer confidence was sliding a little bit earlier in the year, and then it recovered. And even the November reading was very strong. When we look beneath the surface, a lot of it is about labor markets. It's about jobs. Consumers think that the labor market right now, it's easy to get a job, easier to get a job than not. And looking out into the future, our expectations gauge has been positive, on net positive, for 2 months. And that's after almost a year of being negative, even though most people were working. So I think the fact that consumers are more confident that they're going to stay employed, that's going to support consumption going forward. Is there a lot of uncertainty, especially around taxes? And if there are any trade issues that cause inflation to rise, yes, consumers are thinking about that. But for now, they're confident.
Dana Peterson of the Conference Board, thank you so much for being with us. Joining us now is Scott Chronert of Citi. As we ask the question, how bullish can you get heading into next year with American exceptionalism rolling off everybody's tongue? So, Scott, why are you not the most bullish one on the street?
I just think we have to allow for the starting point, right? Valuation's very extended, 24, 25 times earnings. If you look at forward 12-month returns historically from this valuation starting point, S&P is down 9%. If you look at where the sentiment indicators are right now, our Levitt index, from these levels historically, forward 12-month returns down 9%, right? So while we're quite constructive on the fundamental setup going into next year, and it potentially even gets better as we get further down the Trump policy path, we have to allow that somewhere in here, Dana used the word shock, it's a big term for me as well. We have to look for, the risk of some shock effect coming in that distorts sort of the euphoria that we've been contending with over the past couple of months, particularly as we've seen this major flow surge go into U.S. equities on the heels of the election.
It's a weird one because there is so much uncertainty. To your point that there could be shocks, there are so many unknowns, and there are a lot of known unknowns, a lot of gray swans, yet everybody is crowding around a very bullish case for 2025. In putting together your year ahead outlook, how difficult was it? Was it a pretty simple call to say we're going to keep rallying, things are going to look great? Or was it more difficult than most years? Again, just given the sort of political shift that this market's likely to undertake.
The data says you ought to be a little bit cautious here, right? And so the way we're navigating this is that when I look at the transition here from administration, so we're going from election uncertainty to policy uncertainty, okay? We're starting to see the appointee list extend. Now, what we have to begin to prepare for is that there's going to be some noise as we get further down the policy path. Okay, what does the platform actually look like? How do you implement many of these initiatives that Trump is all about? On the other side of that, you start looking and thinking about policy opportunity. Okay, great. We've digested the news. We've gotten the platform. We've got the appointees in place. Okay, and all of that's happening during the first quarter as Q4 earnings are being reported. Then from there, you get to a point where you can start looking more constructively at the outlook, because at that point, you alleviate the uncertainty. You ought to begin to see corporates get a little bit more aggressive with things like growth CapEx, which is a good leading indicator of future growth. So ultimately, where all this goes, we got to navigate a period in here. I'm going to call it sort of first quarter, where we're looking for a volatility episode of some form. But then beyond that, you begin to extend out into the middle part of the year. You look forward to 2026, earnings growth continues. And the world's a pretty good place, particularly if you're focused on U.S. large cap equities. We think the opportunity set is probably even better in that context, going down cap into small mid cap. So all told, we're quite constructive on the outlook for U.S. Equity fundamentals. It's just a question of timing this around the current setup as we kind of go through this flow flush into year end.
But what's to say the shocks might be for something on the downside? Donald Trump is going to be ringing the opening bell today. This is an individual who's been regulated in the past by the Dow Jones.
So we know that and you look at who he's surrounding himself with in terms of appointees. I think the good news is that there's a market friendliness aspect of what's going on, and there's an attentiveness, and this is really important in our view, attentiveness to how you stimulate growth, how you balance that with some of the tariff talk, with some of the deregulatory talk. But importantly, what I think is most encouraging for us is that you've got some individuals in place that are a little bit more focused as well on the spending side of the equation. 6 months ago, as we were kind of navigating through the election diatribe, there was almost no focus on how to think about cutting spending. What the market really wants longer term is a sense that there's some sanity at work here, that we get it. We need to stimulate economic activity, but we have to do it in a judicious fashion where we're very attentive to where the deficit math has taken us.
So your base case is 6,500 for year end next year. Your bull case is 6,900. Bear case is 5,100. I'm just curious within that. You said you're constructive down cap. Do you think that small caps will do the best, and is this contingent on rate cuts?
I don't think it's contingent on rate cuts. I think small cap is the best setup, if you will. The valuation hurdle's the lowest of the various asset classes within equities. What's really important is that where consensus numbers are taking you right now is that small cap hasn't had any earnings growth for the past 2 years. It's been lagging well behind large cap in that regard. The math right now is that large cap earnings growth, particularly for the Mag 7, begins to decelerate off a lot of large numbers going into next year. The sentiment, the consensus numbers are also pointing towards small cap seeing, sort of a growth acceleration. So what you're looking at here is this bigger theme in the market of what we're going to call, earnings growth differentials narrowing. What that ends up doing is supporting the case for areas such as small cap, probably the value side of the market as well, and it even allows you to expand out the economic sensitive side of the ledger as well. So the broadening that we're looking for from a fundamental perspective is part of ultimately how and why we stay constructive. It's just a measure, at this point, it's really just a matter of timing your entry points.
Scott Chronert, wonderful to see you in person. Scott Chronert of Citigroup here with us in New York. Up next, setting you up for the day ahead, including ECB President Christine Lagarde's news conference, which we will be taking live. This is Bloomberg Surveillance. Futures lower ahead of the opening bell here in New York after getting initial jobless claims that exceeded expectations, not necessarily more than before. S&P futures down by about 0.25%. What you could see is yields marginally higher in the U.S., dollar ascendant as you see rate cuts across the board. Here's the trading diary through next week after we get the ECB rate decision, or the press conference with Christine Lagarde in just moments. Monday, we have the S&P global PMIs. On Tuesday, we have retail sales. On Wednesday, we'll get a Fed rate decision at 2 p.m. Eastern, followed by a Chair Powell news conference. Thursday, another round of jobless claims, and Friday, core PCE and UMich sentiment as we watch Christine Lagarde come to the podium. Danny, what are you listening for to hear what she has to say?
Well, clearly the statement, the doves have had their way in terms of removing restrictive from the statement. Does Christine Lagarde reflect that? Or is this a Lagarde who's going to be, as she has been, really reserved and talk about data by data and the meeting depending on that rather than projecting forward and any sort of accommodation they might need for the weakness to come?
For me, it's the split screen, the difference of the ocean, whether it's the S&B, the ECB, and how much more difficult their job is going to be because Donald Trump and his presidency, and he's going to be ringing the opening bell at 9:30 this morning at the NYSE.
Yeah, especially at a time where this was an ECB that removed reference to keeping rates restrictive at a time where they are concerned about growth. There is going to be a question asked to Christine Lagarde in this press conference. Why did you not cut by 50 basis points at this meeting if you were concerned about growth? How she answers that, Anne-Marie, could really determine what we see in markets.
Potentially, and what we could see next year. Does she go for 50 basis points in January, or does she potentially hold off and wait for March?
And at a certain point, you have to wonder how much this really does leave the dollar ascendant at a time where it's hard to see where the nodes of growth are. Just to recap, the ECB did cut rates by 25 basis points. What they are looking for is to remove restrictive as in terms of what they want to see for their rates in their statement. And right now you see opening statements from De Guindos ahead of Christine Lagarde's speech. I'm just curious, though, at what point, Danny, do we end up seeing this divergence become a difficult thing to maintain? There was such a long time that we talked about how at a certain point you had to see that gap close in a global market.
Right. And at what point does a strong dollar become a problem for everybody? We are seeing the dollar strengthen this morning.
ECB President Christine Lagarde getting underway with her news conference.
Today decided to